Okay, I think we're recording now. Some of these slides are a little simplistic, so we can jump through a few of them. You know, ABC, what's ABC stand for?
Activity-based costing.
Good, you read the chapter. Activity-based costing, yeah. It's a supplement to the traditional costing system. This is just an extra tool that you can use sometimes. And sometimes it's helpful, sometimes not. There's a certain cost involved in terms of time. You know, the numbers don't pop up by themselves. You have to crunch them. So let's skip through that one. And how costs are treated under activity-based costing compared to the traditional way. Remember the traditional way? There are three manufacturing costs: direct material, direct labor, and factory overhead. Those are all product costs, and we ignored the selling and administrative stuff when we were computing cost of goods sold. It's a little different under activity-based costing. Activity-based costing, you look at some manufacturing and also non-manufacturing costs. We'll see how that works. So it does not assign all manufacturing costs to products, which is a little bit different. Does this violate generally accepted accounting principles?
I would assume not.
Assume not? What's your second choice? Begins with Y? Yeah. For what they call GAAP, generally accepted accounting principles. Those are the rules that the Financial Accounting Standards Board made years ago. They're still making them. But basically, they say these are the rules you have to follow for your public financial statements, like the annual report, the quarterly report, the filings you have with the Securities and Exchange Commission if you're a publicly traded company. And we have those four costs: direct material, direct labor, and both the variable and fixed portion of factory overhead. Those are all part of cost of goods sold, which become part of ending inventory, which become blah, blah, blah.
Does this have to follow it because it's an internal procedure?
Yeah, for internal procedures, it can be different. And this chapter 6 is one of those internal procedures. Well, most of this course is about internal procedures, actually. But this is just to highlight the fact that there are some differences between ABC, activity-based costing. It's a kind of management accounting technique or tool. It's different than financial reporting. So the numbers you get under activity-based costing won't be the same numbers that appear on your annual report. And that's okay, because the annual report is to show information in a certain generally accepted format, whereas management accounting in general, and ABC in particular, it's meant to do other things. It's to show you things like, you know, profitability, how are these costs allocated, and so forth. This isn't the kind of stuff you would report in the annual report. It's not the kind of things you would want to report either. Why wouldn't you want to report this information in your annual report?
Yeah, like misleading or your end result when you report something that maybe not is. I just say it would be misleading.
Yeah, that's not what I was thinking, but yes, that's also a correct answer. Yeah, it could be misleading. Financial statement readers, those that know what generally accepted accounting principles are, when they read a financial statement that's made with another set of rules, like activity-based costing, they may be misled. And in the United States, that means class action lawsuit, right? Other countries, they don't have class action lawsuits for the most part. Very difficult, but America, the land of corruption. Yeah, well, corruption is a way too to get around the system. But yeah, but what I was thinking is you don't want your competitors to know what your profit margins are, how profitable your customers are, because, you know, think about it. If they knew which customers or class of customers were the most profitable, that's where they would go. You know, they say, oh, look at this. Our competitor in the next town says that this customer base is a 40% profitability rate. Let's go after those customers. They know who to target. Or let's say that the Asian operation has a 40% profit margin, whereas the domestic market is only 12%. Let's expand in the Asian market. We have a couple $100 million to expand somewhere. Let's go to Asia. You don't want them to know that kind of information. Or for profit margin, let's say that you make a product that's very similar to that of 5 or 10 other companies. If they know what your profit margin is and you have a price war, they know how low they can go. before you lose money. And if their break-even point is lower than yours, they can win, in a sense. I mean, if anybody wins a price war, and that there's a whole debate in the economics literature about that actually nobody wins, because if you drop the price low enough to drive everybody out of business, you'll have all the market, but you'll be decimated because you've been losing money. And then you have all these bankrupt producers that sell their stuff for 10 or 20, 30 cents on the dollar. Then you'll have a bunch of low-cost producers that you can't compete with anymore because you have higher costs. There's a whole body of literature on that, antitrust. What's that guy's name? Dominic Armentano, Armentano. He wrote 3 books on it. You only have to buy the most recent one because it's a regurgitation of the first 2. Armentano, Armentano, Dominic, or sometimes it's DT Armentano. So, I mean, you guys like to read in your spare time, right? If you want to read a couple hundred pages on that. I forget what the name of the book is. I think it has antitrust in the title somewhere. But it has to do with trying to drive competitors out of business and how it's not economically feasible to do that because you weaken yourself. And plus, you wind up with low-cost competitors if you're successful, which means you're the next one to go bankrupt. Each ABC cost pool has its own unique measure of activity. Traditional cost systems usually rely on volume measures such as direct labor hours and or machine hours. We know that already. We sort of know this too. Here we have activity cost pools, or a cost bucket, in which costs are related to a single activity measure. You accumulate those costs and keep track of them. We've had cost drivers in other chapters. Can you give me the 2 examples that pop up most frequently? Cost drivers. Remember that from a few chapters ago? Initials for one would be DLH, direct labor hours. And you waiting for me to give you the next abbreviation? MH, machine hours, right? Machine hours. Yeah, those are cost drivers. The more hours you use the machines, the more cost you have for those machines. The more hours you have the workers work, the more your labor costs are. So those are cost drivers. That's what they're talking about. But those aren't the only cost drivers. There could be others. 2 common types of activity measures: the transaction driver, simple count of the number of times an activity occurs. You know, if you have 14 deliveries a week, for instance, 14 times 52 or whatever. Duration driver, the measure of the amount of time needed for an activity. If it takes you an average of 63 minutes to service a particular account every week, or if the average account, no matter where it is, takes an average of 63 minutes or something, that would be another way of measuring things. Activity-based costing defines 5 levels of activity that largely do not relate to the volume of units produced. If there's some kind of a cost that's not directly related to volume, what kind of cost might that be? Did you say fixed cost? I thought I heard you say fixed. Yes, fixed cost. Sometimes my ears deceive me. Traditional cost systems usually rely on volume measures such as direct labor hour and or machine hours. Those are cost drivers to allocate overhead costs. Now the thing is, with overhead costs, the mere fact that they're overhead means you cannot trace them directly, or the cost of tracing them exceeds the benefit. And you can still allocate them. You know, just like that example I give every week about the trust department in the bank, and the rent costs were allocated on the basis of square feet. Yeah, what was wrong with that approach? Do you remember? Allocating rent on the basis of square feet.
They had big offices.
Yeah, they had big offices. In the trust department of the bank, they were mostly lawyers. Lawyers had bigger offices to sort of soothe their egos, I guess. They're the ones who had windows, things like that. The rent was allocated on the basis of square feet. And when it was allocated, their small profit turned into a small loss because you had to deduct their allocated portion of the rent. So some costs, even though you can allocate them, you should not. It depends on the cost of doing it exceeds the benefit, and here it bruised their egos, and it didn't really do anything other than bruise their egos, because what are you going to do if you're allocating costs? It's arbitrary anyway. So some costs are not allocated, you just deduct them from the headquarters. Remember that from, can't say last week because you took a really nice exam last week, right? I'm just trying to get some kind of response there. It's not the one I was hoping for, but okay. Manufacturing companies typically combine their activities into 5 classifications. Unit level, batch level. You may be familiar with batches. Like if you have a bakery, they throw in a bunch of ingredients and out comes bread or donuts or something. You know, that's something that's batch processing. Product level of activity, organization sustaining, which is a fancy way of saying don't allocate this. It's a headquarters cost, like the president's salary, something like that. Customer level activity, if you can allocate it to a particular customer. And there we have some strong top managers. I don't know why they did that, just to make it look like it's not an accounting course, I guess. There we go up the corporate ladder. Here we have a bunch of excited accountants. They're obviously marketing people. Okay, so here we have our first number cruncher. The case of Baxter Battery. This is their income statement for the year ended December 31st, 2014. What format is this? Is this a traditional format or the contribution format?
Traditional.
Yes, traditional. It's the same thing you had in the financial accounting course, right? You have sales minus cost of goods sold equals gross profit or gross margin minus selling and administrative expenses. The bottom line is a net profit or net loss. Yes?
Sorry, before we dive into the numbers, and I apologize if I missed this in the beginning, but what's the benefit for using this method over the other, like over absorption? Is it just a better, more accurate product cost? Is it?
It's different. You know, the question is, what's the advantage of using what contribution margin approach?
No, the ABC versus like.
Oh, the
any other
ABC.
costing method.
Oh, okay. What's the advantage of using ABC, activity-based costing? It gives you extra information that you wouldn't necessarily get just from using the regular approach. It may or might not be useful. It just depends on the company, what you make.
Okay.
You know, if you want to know what the cost is per customer or the profit margin per customer, let's say that you have 50 people on the sales staff. You send them out into the field, but you have so many customers you don't know what to do. That's a good place to be. But let's say that you have to pull back in some markets or pull back in some product lines. How do you decide? You know, you want to keep the most profitable customers. You want to get rid of the ones you lose money on, unless they're a loss leader, which is usually not the case. So how do you determine that? Well, you can determine that through activity-based costing. You can calculate which customers are profitable, which ones are the most profitable, or which product lines are the most profitable, which ones do we lose money on. Activity-based costing is another tool that you can use to sort of fine-tune those calculations. So getting back to here, the traditional income statement, sales minus cost of goods sold. Notice there are 3 components of cost of goods sold. Well, this is one way to do it anyway. Direct material, direct labor, and manufacturing overhead. I said this is one way to do cost of goods sold. What's another way? Isn't cost of goods sold the combination of 3 items? Yeah. Beginning inventory plus purchases minus ending inventory. Yeah. This one is for a manufacturing company. The other approach, beginning inventory plus purchases minus ending inventory, would be for a retailing company. 2 ways to compute cost of goods sold, depending on what kind of company you have. So this one must be for a manufacturing company. Then gross margins, whatever's left. Then you have selling and administrative expenses. And in this case, they have a $2 million net operating loss because their expenses exceeded their revenues. Manufacturing overhead is allocated to products using a single plant-wide overhead rate based on machine hours. Remember from a few chapters ago, what's the advantage of having one single plant-wide rate?
The predetermined rate?
Yeah, the predetermined rate. manufacturing overhead. In this case, they just have one that goes across the whole factory. Oh, it was like 3 weeks ago, maybe. Should I forgive you because you forget after 3 weeks? No,
And because we almost got shot a few weeks ago.
oh, that was, yeah, somebody almost got shot, but it was on the other side of campus. That was a few weeks ago. Yeah, you tried. Okay. Okay. So anyway, the single plant-wide overhead rate, in this case, it's just machine hours. It could be just labor hours. It just depends. This company thinks machine hours are better, maybe because it's machine intensive, capital intensive. There's an advantage and a disadvantage. The advantage of a single plant-wide overhead allocation rate is that it's easy. Remember that? It's easy. What's the disadvantage?
It's hard.
It's not accurate, right? It's not accurate. Let's say that the factory manufacturing operation consists of two main things. In one part of it, you use a lot of labor. The other part, you use a lot of machine hours. You should have two rates then. Machine hour rate for the part that uses a lot of machines, and direct labor hours for that segment of the operation that uses a lot of labor. That's more accurate. That's the advantage of having more than one allocation rate or formula. But what's the disadvantage?
Difficult.
More, what's the second word begins with C? O-M, complicated. Yeah, more complicated. So there are advantages and disadvantages of both. Here you have a single plant-wide rate. The advantage is it's easy. The disadvantage is it's not as accurate. It's not a fine-tuned kind of thing. It's a rough estimate. If you have different allocation formulas for different phases of the manufacturing operation, like you could have two machine hours and direct labor hours, it's more complicated. That's a disadvantage. But the advantage is it's more accurate. Gives you a better reflection or depiction of what your cost structure is. So notice I'm doing a review here as well, right? In the second exam, you might need to know stuff from the first 5 chapters, although I'm only going to test you on the material after chapter 5. At Baxter Battery, the ABC team selected the following activity cost pools and activity measures. They have 5 activity cost pools, or really 4. Customer orders are based on the number of customer orders. The design changes are based on the number of design changes. Order size based on machine hours. Customer relations are based on the number of active customers. And then other, they don't have one of those. So we don't have to worry about that one. For customer orders, you assign all costs to resources that are consumed by taking and processing customer orders, which means you have to keep track of those costs. And if this is a major component of the business, there are special bill of forms that are already pre-made out. You just fill in, the name of the customer, the number of the contract or whatever, how many hours, how many minutes, and perhaps the rate per minute, because different employees cost different amounts. For design changes, assigned all cost of resources consumed by customer requested design changes. There are a few things involved there. Direct labor might be the most important one, and there might be some overhead things involved. Order size, assigned all cost of resources consumed as a consequence of the number of units produced. And customer relations, assigned all costs associated with maintaining relations with customers. Some people are assigned just to maintain relations with customers, and other times it may be the sales staff that does that. They might spend 20% of their time just sort of schmoozing with the customers, taking them to lunch, showing them pictures of the grandkids, stuff like that. That costs because you're paying them, and you have to allocate their salaries based on how much they work and so forth. So customer relations could be part of that. And then other, assigned all organization sustaining costs and unused capacity costs. You wouldn't allocate those to particular products because, why? Finish my sentence. Other, assigned all organization sustaining costs. Things like the president's salary, the rent on the headquarters in New York, things like that. You would not allocate those to any job, any product. Why not?
Because they're period costs.
You're not afraid to take chances, I'll give you
They
that.
said it in the book.
Oh, it says that in the book?
Yeah,
Okay.
the ABC method uses those as period costs, and they don't assign it to the product.
Yeah, yeah. Well, they are period costs. The president's salary is a period cost. Yeah, and period costs don't get assigned to the products. And also, if you did assign them to the products, what would be the purpose of doing that? You would get the managers mad. You would reduce their bonuses. If their bonuses are based on a percent of the bottom line, you're allocating 20% of the president's salary to their product or their division, their bonus drops, they get angry, they say the president's being paid too much, and you have all kinds of internal dissension. And some of the most productive profit centers, managers of those profit centers, may decide to go someplace else because they're mad. You ever notice that if you work in a place where people are leaving because they're upset? It's usually the best people who leave, and it's the not so good people who stay because they don't have other options. So in order to prevent things like this is called behavioral economics, by the way. That's a little subfield, behavioral economics. You don't want to make people mad unless there's a good reason to make them mad. You don't want to get them upset unless there's a good reason to get them upset. And so allocating some of these costs, like the president's salary or the cost of the rent and property taxes on headquarters 1,000 miles away, doesn't make sense. There's no good reason to do that. And bad things happen if you do that. Assign cost to cost pools using a first stage allocation. So here we have the overhead costs, indirect factory wages, factory equipment, and so forth. Then general administrative department, administrative wages and salaries, office equipment, and so forth. Where does depreciation appear on the income statement? Can it appear in more than one place? Yeah. How many places can it appear? Three, exactly. Does anyone want to tell me where they are? In the income statement, there are 3 places where you might have depreciation expense. Selling, right? If it's depreciation on the fleet of delivery trucks, that would be in the selling expense section. What about depreciation on the president's desk? Where would that appear? Begins with A. DM, IN, administrative, right? And depreciation on the factory machines would be part of cost of goods sold. I mean, it might not be separate, saying depreciation on equipment. It would be part of cost of goods sold. So there are 3 places where depreciation might appear. And you notice in the production department, the second line there, $3,500,000, factory equipment depreciation. That would be a product cost. General administrative, the second item there, office equipment depreciation. Marketing department, they don't have depreciation listed there, but if they had a fleet of delivery trucks or automobiles that the sales staff uses, you could have depreciation in the marketing department as well. So anyway, we have these overhead costs. Here we add all 3 types together. Production department has overhead, so does administrative, so does sales or marketing. This is a little different than what we had before because we used to split it up into product costs and period costs, right? We're not doing that in this chapter. Here we're just looking at the overhead costs. We're combining all 3 categories of overhead costs together. Direct materials, direct labor, and shipping are excluded because Baxter Battery's existing cost system can directly trace these costs to products or customer orders. Again, one difference between direct costs and indirect costs, well, the main one, is traceability. If you can trace a cost to a particular product or customer, it's direct. If you can't trace it, or if the cost exceeds the benefit of tracing it, then you call it overhead, and then you do something else with it. So here we have the distribution of resources. Again, the nice thing about these textbook problems, they give you the percentages. You don't have to figure them out yourself. So let's look at the columns. They have activity cost pools for customer orders, design changes, order size, customer relations, and other stuff. In the production department, indirect factory wages are 30% of the total, and design changes are 30%, and so forth. I'm not going to read through all those, but they should add up to 100% unless there's something wrong. Administrative wages and salaries, that's 30, 10, 10, and 20. That doesn't add up to 100%. Why not? Is that a mistake or what?
The one below it doesn't even-
Yeah, not everything adds up to 100%. It means, something is missing, or maybe some of it just doesn't belong in an activity cost pool, if it's not to be allocated. Did you ask yourself that question when you looked at this? Why don't some of these things add up to 100%? You did, right? Okay, that's good. It means that you noticed. Yeah, the ones that don't add up to 100% just means something's not getting allocated, like the president's salary or the rent on the headquarters 1,000 miles away.
So is it like, they're leaving it open to anything that's gonna occur? It has that space to be allocated?
No, they've just decided certain things won't be allocated,
And
like the
it's-
president's salary.
So you don't have to, got it.
Yeah, stuff like that.
Okay.
So why the 100 if it's not?
Yeah, that's a good question. Why is the column on the far right 100%? I don't know why the authors did that. Maybe just to emphasize the fact that some stuff isn't included.
I mean, it would make sense to just leave it open to anything that may occur to fit in that
Mm-hmm. Yeah,
box.
yeah, you could leave a blank space that says other. They have other, but it's not blank. But
It
yeah.
won't add up to 100.
Yeah.
We just left it.
yeah, there's some stuff going on that's not going to be allocated. So what we do is we take these percentages and we multiply them by something. And that's what the rest of the chapter is about. But don't go home yet. Next question?
You take the percentages and multiply it by something. So in a case where there is less than 100, what do you do?
Yeah, if you take a case where there's less than 100%, some things just don't get allocated. If only 70% of the total is there, 70% gets allocated, 30% doesn't. So let's take a look at indirect factory wages. What would be an example of indirect factory wages? Janitor, yes, my favorite example. The janitor. You can allocate the janitor's salary among the various products or services, but you can't really trace it. Because, if the janitor sweeps up the floor and you make 14 different products on the factory floor, how can you trace that? You can allocate it, and that's what they do here. Let's say indirect factory wages are 600,000, and the percent consumed by customer orders is 30%. So 6 million times 30% is 1.8 million, and that gets listed here as indirect factory wages, 1.8 million. And you do that for all the other ones. Factory equipment depreciation, 3.5 million times whatever the relevant percent is. And you do that for all of these things. I'm not going to go through all of them, but are there any questions about anything on this screen? No? Okay. Yeah. There's a lot of numbers in this chapter. And the main question you have to ask yourself is, what do we do with them, basically? You multiply one by another or you divide one by another. That's basically it. For factory equipment depreciation, again, the 3.5 million, the percentage there is 20%. So 3.5 million times 20% is 700,000. You list that under factory equipment depreciation. And when you're done doing that, let's take a look at indirect factory wages. The first one, at 6 million, allocated 1.8 million, 1.8 million, 1.2 million, and so forth, just based on those percentages. And then when you do all of those calculations, you add them up. The bottom line for customer orders, for instance, 4,520,000, design changes 3,040,000, and so forth. What do we do with those numbers to make them meaningful? Or is this it? Is this the end of it, or is there something else we're going to do next? Yeah, we're going to do something else. Does anyone want to tell me what that is? What do you do with those numbers on the bottom line? That 22 million that's allocated among those various cost pools. And maybe divide it by something. Yeah. Divide 4,520,000 maybe by the number of customers to find out the cost per customer order. That might be good. How about design changes? 3,040,040, would you divide that by anything in particular?
How many designs you make?
How many design changes you made? Yeah, things like that. And then what do we do? Is that it, or is there more? After we get those numbers, something divided by something else. Well, there are a few things we could do. One thing is to assemble those numbers in the right order to see, which customers are the most profitable, which product lines are the most profitable, things like that, which ones are losing money on. A number of things you can do with them. So compute activity rates for cost pools. The activity-based costing team determines that Baxter Battery will have these total activities for each activity cost pool. They have 10,000 customer orders. Oh, you're probably going to want to divide some dollar amount by 10,000 for that, right? The cost of customer orders divided by 10,000. The cost of design changes divided by 4,000. The whatever that machine hour number is divided by 800,000. And the cost of customer served divided by 2,000. And you get some number. Now the team can compute the individual activity rates by dividing the total cost for each activity by the total activity levels. And when we do that, this is what we get. Again, customer orders, 4,520,000 divided by 10,000, 452 per order. Yeah, if we were to criticize this chart or any numbers on this chart, what would be a good criticism to make? Yeah, are you saying that not all customers cost you $4 or $452? Yeah, this is only an average, right? Some customers might cost a lot more. Some might cost less. Did I tell you the story about when I was a collector for a bank and I went into this junkyard? Did I tell you that story yet? Oh, it's an interesting story. Well, at least I think so. Anyway, there was this one guy. It was back in 1971, 72, something like that, when you could live on $500 a month. You could actually almost raise a family on $500 a month back then because the currency wasn't as inflated as it is now. And so anyway, I was like the assistant manager of this bank, and because I was the assistant, I had just enough authority to go and knock on doors and try to collect on delinquent loans, because we would do it door to door. And it was a small town in Ohio. Most of the people were immigrants from West Virginia. They worked in the auto plants and the steel factories and so forth, and they weren't used to making a lot of money, and so they were making a lot of money, but they were spending it a little faster than they would make it. So there were a lot of delinquent loans. I did repossess a TV on Christmas Eve one time. Yeah, it was a Saturday. I walked in, the kids were there in their pajamas watching cartoons. I had to unplug it and take it away. The boss said, "Don't come back without it." So that's part of the stepping on people's backs to climb the corporate ladder, I guess. I don't know. But anyway, the one I was thinking about was there was this junk dealer in town, and he would always wait for the price of copper to rise. He always thought the price of copper was going to rise, so he would never liquidate his copper inventory and turn it into cash. As a result, he'd always be delinquent on his loans, and he'd come in and he'd borrow like $200 or $300, which that's chump change today, right? But in those days, it was a half a month's pay, which is still maybe chump change. But anyway, he would come in and borrow it, and he would always be late, and we knew that he would always be late. But we made more money on him than we did on the customers that paid on time because we charged him late fees. So we charged him the regular interest rate plus late fees, and when I'd go to the junkyard, I'd always go around lunchtime because he'd always offer me lunch, and he made pretty good lunches. So that was a tax-free benefit for me. So anyway, getting back to this, the average customer order cost $452. It didn't cost us much to do business with him because there were special things like free lunches and late fees. And so if you wanted to fine-tune this, the 452 could become 300 in some cases and maybe 800 in other cases. So that 452 is just an average. If you take individual customers into account, you might tweak it a little bit to get either discounts or premiums for particular customers based on the actual fact situation. Anyway, that's one of my junkyard stories. Anyway, there may be others during the semester, but that's one. Okay, any questions about anything that's on this chart? No? You know how to do it, right? The numbers in that left column came from the prior slide, and then the 10,000, the 4,000 they gave us, you just divide one by the other, and that's what you do. So now we have to figure out what are we going to do with all that stuff in the right-hand column, the activity rates. How much longer should I hold you in suspense? No? How much longer? You're saying, please go to the next slide, I want to see. Okay. Well, here we go. You already saw this because you do your homework. So we have direct material, direct labor, and shipping costs. Those are all things that can be traced. Then there's that other category, the overhead costs. Those are costs that cannot be traced, but they can be allocated. And if we decide to allocate them, we can come up with a better total cost picture for different things, like products, customer orders, and customers, and so forth. So we have, in the overhead cost category, we had 5 categories, but really only 4 because we're skipping the other. But customer orders, design changes, order size, customer relations, in addition to the 3 categories of direct costs that we can trace. Then we have a second stage allocation. So much per order, and then dollars per change, and then dollars per machine hour, cost per machine hour, and cost per customer. We can come up with that information. Then you notice in the lower right-hand side, unallocated. Again, you now know the reason why we don't allocate everything, right? Why do we not allocate some things? Nothing good can come from it sometimes. What's an example of something we should not allocate? The president's salary, or the rent on the factory building 1,000 miles away, or the square feet in the trust department of the bank. So assign cost to a cost object using the second stage allocation. So they have 2 kinds of batteries, Sure Start and Long Life. Sure Start requires no design resources. 800,000 batteries ordered with 4,000 separate orders. What do you get the urge to do when you see those numbers? Divide, exactly. Don't you want to divide 800,000 by 4,000? That's the urge I get anyway. Each Sure Start requires 36 minutes of machine time for a total of 480,000 machine hours. And the Long Life battery does require new design resources. 400,000 batteries ordered with 6,000 separate orders, so you can take 400,000 divided by 6,000. And 4,000 custom designs prepared. Each Long Life requires 48 minutes of machine time for a total of 320,000 machine hours. Now for these minutes, like 36 minutes, 48 minutes, there's a couple ways we can deal with this. One way would be to figure out the cost per minute. What would the other way be? If we're talking about direct labor hours, should we convert that 36 minutes into hours? Yeah, what would the decimal be for 36 minutes? Be 36 divided by 60, right? Or 6/10, 0.6. 48 would be 0.8. Okay. So here we have overhead costs for Sure Start. You have the activity cost pools. They only have 3 of them there because they didn't have that one category, design changes. So you have the activity rate that we determined, $4 or $452 divided by 4,000, or times 4,000. The activity rate per unit times the number of units, 4,000. So that's 1,808,000. And the design changes, the activity rate is 760, but they didn't have any design changes, not for the Sure Start. So that's, we can ignore that or multiply it by 0. The order size, the activity rate there, 6.5 times 480,000. So we add those up, we get 4,928,000. The overhead for Long Life, we compute that the same way, but with different numbers. Again, the activity rate for customer 452. Here we have design changes. Design changes were 760 times, in this case, 4,000. We didn't use that in the other one because they didn't have design changes. And then the order size is 6.5 times 320,000 for a total of 7,832,000. What do we do with that? Or those? The 4,928,000 and the 7,832,000, what do we do with those?
And
Yeah, we would add those. Remember, we had the direct cost. How many categories of direct costs are there in this example? These are T3. Yeah, direct material, direct labor, and then delivery costs or whatever it was. Which why do we have 3 direct traceable costs here, but in those other chapters, we only had 2. We only had direct material and direct labor, right? There were 3 categories of manufacturing costs: direct material, direct labor, and factory overhead. So direct material and direct labor are the 2 we can trace. In this example, we have 3 things that we can trace: direct material, direct labor, and that other thing that's involved with delivery. Yeah, the first 2 are manufacturing costs, but the other one is the selling expense, right? Delivery costs. Yeah, shipping costs are considered a delivery cost or a sales cost. Why is that? Is there a reason for that? Let's say you manufacture something and it costs you $300 to ship it someplace. Where does that $300 appear? It appears under selling expenses. Doesn't appear as part of cost of goods sold. Why is that?
How does it vary?
Did you say because we're applying the principle of responsibility accounting? I thought that's what I heard. Yeah. Now there's 2 kinds of shipping costs, right? They call it freight in if it's coming into you. Like raw materials, you pay the freight. That's part of cost of goods sold. Anything that comes in that's associated with the manufacturing cost, if it comes in, that's part of cost of goods sold, like freight in. Material cost that you have to purchase, if you have to pay the freight, that becomes part of cost of goods sold. Freight out is the selling expense. So just because it's freight doesn't mean it's one or the other. It depends on whether it's coming to you or whether it's going out. The reason that freight out or shipping costs to a customer are considered selling expenses is because they're triggered as part of the selling function. Now think about it. The salesperson who's in the field might say, if you buy 100 units, we'll pay the shipping. Well, he's just agreed to absorb the cost. So that would be a selling expense. It's traceable to the sales function. And that's why freight out or transportation out is considered a selling expense, not part of cost of goods sold. That's why we have 3 traceable costs in Chapter 6, whereas we only had 2 before. So we're getting more sophisticated now. Can you feel the internal sophistication mounting? Not yet? It's there. Just breathe in, count to 10, breathe out. Do that 10 times and you'll start to feel the sophistication. So assigning overhead to customers, let's take a look at how Baxter Battery System works for just one of the 2,000 customers. Acme Auto Parts replaced a total of 12 orders. Note that the 4 orders for long lives required a design change, but the other ones didn't. Then for orders, 8 orders of 60 sure starts per order, 4 orders of 50 long lives per order. Don't you get the urge to multiply something? You just have to figure out what numbers to multiply. Then for machine hours of 480 sure starts required 288 machine hours. So you could figure out how much per machine hour, but you probably want the total. And the 200 long lives required 160 machine hours. So the overhead costs, starting with customer orders, 452 times 12. Design changes, 760 times 4. Order size, 650 times 448. Customer relations, 1540 times 1. So the total costs, overhead costs for Acme Auto Parts, $12,916. And we would do that for every product. Using activity-based costing to compute products and customer margins. You know, which are your most profitable products or which are your most profitable customers? If you're losing money on a customer, you may consider dropping that customer. Notice I didn't say you will drop that customer because there's more to it than that. If you're losing money on a customer, why would you not want to drop that customer?
You said something about a loss leader?
Yeah, a loss leader. That's the excuse sales staffs use when they sell something at a loss. You know, you get them into the store to buy something that's on sale, and then you run out and you say, "Oh, gee, sorry, we're out of this one, but we have these 14 other things you might be interested in." They might start off as customers you lose money on, but once you're into that market, or once you have your foot in the door of that customer, maybe you can sell that customer some other things. And in fact, a lot of times, if you look at the ratio of profits and losses for particular new markets, a lot of times you go into a new market and you lose money the first year or two. And then, you know, once it's established, once you expand, like when you're setting up a new sales office, if you decide to set up a new sales office in South Carolina, for instance, you start with no customers, or maybe the existing customers that you used to service from the North Carolina office, you might lose money at first, but then when you have a sales office right there in beautiful downtown South Carolina, you can expand and you can tap into the market deeper. And so you might eventually make money. So just because you're losing money on customers doesn't necessarily mean that you drop them. It just depends on the facts and circumstances. But first you have to figure out, are we making money or losing money on these customers? And the same with the product. You know, if you have 5,000 products to sell, which ones do you push? The ones that give you the highest profit based on something or other. Not necessarily the largest bottom line, but maybe when you send the sales staff in there, how much can they make per hour of sales work? Now, if you send them someplace and they make $200 an hour in one place and $500 selling something else, you would go with the product where they make $500 an hour instead of $200, even though the bottom line might be different. But we ran into a little of that before, right? Remember those? Yes.
That's like very close to marketing, like the example you were given before. I think of I shop at Harris Teeter a lot, and when you have this big old community, they got eggs for 77 cents. They are going to bring X amount. They got them in the back, but they're going to bring X amount. They get you in the store, they never there. They write you a little, the rain check, and then, but you don't leave the store. You got thousands of million items to choose from, and they do that every week, and it's so successful because I'm going to keep to myself.
Yeah.
Because guess what? They can give me back twice, because then I'm going to do my rebate check or my rate check or whatever. I mean, but not like it is, so.
Yeah.
So,
Yeah. For those in cyberspace, we're talking about the Harris Teeter example, the eggs for 77 cents to draw you into the store. And then they run out, but you're already in the store, so you buy other stuff, and they give you rain checks, or they get you to come back again, twice, 3 times. Yeah. So there are ways. Those marketing people are slick, aren't they? Again, the bean counters just count what the marketing people generate. So we use activity-based costing to compute product and customer margins. Which ones are the most profitable? Which ones should we drop? Because we have constraints, right? Only so many hours in the day, only so many sales staff. What should they push? Where should they push it? So product margin calculations, the first step in computing product margins is to gather each product's sales and direct cost data. And here we have it for the 2 kinds of batteries, sure starts and long lives. And the 3 categories of direct cost: direct material, direct labor, and shipping for each.
What does it mean by product design when they're asked, are they redesigning the battery?
Yeah,
To be bigger, smaller?
they might redesign it. Maybe they would have different outside, what do you call those things? Shells?
Oh, okay.
Yeah. Casings.
Phones, I mean, they just change it a little bit, iPhones or, I mean, laptop, maybe now they have new colors, different
Yeah,
just
different colors, different designs. And like in the case of appliances like Sears, they make Kenmore, is that right? How would I know that? I never buy that stuff. My wife buys that stuff. But anyway, so Sears makes Kenmore, but there's no such thing as the Kenmore manufacturing company. It's made by somebody else. They put the Kenmore name on there. That's a design change. Or maybe the shape is a little bit different. Or what General Motors was criticized for doing one time, they make Oldsmobiles, but they put in Chevy engines. Oldsmobile is supposed to be a higher priced car, supposedly better, but they're using Chevy engines. And they got caught doing that one time, and there was big criticism in the Wall Street Journal. But basically, that's like a customized car where it's part Chevy, part Oldsmobile. It's a design change. You know, and like on an assembly line, a General Motors assembly plant, you have to shut down the line for so many hours or so many days to make product changes. You don't just go and make an Oldsmobile followed by a Chevy followed by an Oldsmobile. You have to make a bunch or a batch of Oldsmobiles and then a batch of Chevys. You can use the same production line, but you have to shut it down and retool and do some other things. And that costs money because the workers get paid even though they're not assembling. That's part of the design change cost. And you might have to bring in different tools or recaliper your whatever tools you use and so forth. All of that is part of the design change cost.
And besides, I mean, you have to innovate in order to keep selling. If it's still, I mean, upgrade or update.
Yeah, upgrade, update, you engage in research and development costs and marketing too. Ask the customers what they want. It's not exactly research and development, but it's the cost you have to incur. Yeah, all of those have to be accounted for by accountants. So all you future vice presidents out there, remember, pay your accountants well. A good accountant doesn't really cost you anything, right? If it's a cost account, if they can save you $5 million, what's a fair wage? Anything less than $5 million, you're ahead, right? Okay, I just throw that out for your consideration so that my brethren in the accounting profession can get high salaries. The second step in computing product margins is to incorporate the previously computed activity-based cost assignments pertaining to each product. So we have the various categories here, sales, and then the 3 kinds of direct costs, and then the ABC cost assignments for customer orders, design change, order size, and so forth. We've already computed all those numbers. Now, what do we do with them? The third step in computing product margins is to deduct each product's direct and indirect costs from sales. So you have sales minus the costs you know about, like direct material, direct labor, and shipping, or the kinds you can trace. And then the ones you allocate, like customer orders, design changes, order size. And then whatever's left is the product margin. You'll notice for Sure Starts, the product margin is positive, highly positive, 8,372,000. Whereas for Long Life's, it's negative, over $1 million negative. So when you look at that, should you discontinue Long Life's because you're losing money?
Look at real close.
Now here's a case where if I ask you a question, there's a very high probability that the answer will be, it depends, right? That's the ultimate answer in accounting, right? Yeah, just because Long Life is losing over $1 million doesn't necessarily mean you should discontinue it. Why might you not discontinue Long Life, even though it looks like it's losing money? What is losing money?
Maybe in the long term.
Maybe it's a compliment to something else that you can do.
Yeah, it might be a compliment to something else. The same people who buy Long Lifes buy Sure Starts. If you discontinue Long Lifes, they'll go someplace else where they can get both, and you'll lose part of the business for Sure Starts. Or maybe the people who buy Long Lifes will also buy something else that's tied in with Long Lifes. So you might lose $1,132,000 on that, but you may make 3 or 4 or 10 million on the other product if they buy Long Lifes and something else, because something else might go with Long Lifes. So the point I'm trying to make is just because Long Lifes is losing money doesn't necessarily mean you should discontinue that product. You have to, and if you're in the business, you'll probably know what is affected. You know, people who buy Long Lifes buy other stuff that's profitable, and if you quit selling Long Lifes, they'll go someplace else where they can get everything under one roof. So there are other things to consider besides just the bottom line that's negative. Although you really should know what that number is, because if you don't, you're not going to be able to plan very well. The product margins can be reconciled with the company's net operating income as follows. This is where they got the $2 million loss overall. But you notice how they structure this. They have the Sure Start sales, total cost, product margins, and then customer relations, that $3,080,000, that's not allocated. And the other costs are not allocated. Some costs are not allocated. What's the advantage of not allocating these costs, the $3 million and the $6,160,000? No good would come of it, right? Because if you allocate it to Long Life and Sure Starts, some managers will get upset. They'll feel bad because they're losing money when in fact it's just an allocated cost. And there's nothing good that can come from allocating costs like that. So, customer margin analysis. The first step in computing Acme Auto Parts' customer margin is to gather its sales and direct cost data. So you have sales minus the direct costs. And then minus those other costs, customer orders, product design, order size, customer relations, and so forth. And the third step is to compute Acme Auto Parts' customer margin of $384 by deducting all its direct and indirect costs from sales. So they have a positive margin of $384. Is that a good margin? How could you determine whether $384 is a good margin? The fact that it's positive is good news, but how good news is it?
Is that for customers?
Yeah, and this is a particular customer, one of their 2,000 customers or whatever it is. They make a profit of $384 on that particular customer. Is that a highly profitable customer or not so highly profitable? How can you tell? Is there a calculation you can make? Yeah, what calculation would you make to determine if that $384 is really good news or just sort of good news?
The customer orders.
Yeah, there.
The sales with that number?
Yeah, sales, compared to sales. $384 divided by sales. Sales are $29,200. So that's like a little over 1%, right? Somewhere between 1% and 2%. $384 divided by $29,200, a little more than 1%. It's profitable because 384 is a positive number, but you don't have much of a margin there, right? If something happens to increase those costs, if you can't pass it on in the form of higher prices, that customer could be a loser. So it's not a great customer, but if you had a whole bunch of customers where you made 1.5%, that'd be okay. Yeah, if you're in the supermarket industry, a 1.5% margin is pretty good, because the supermarket industry, where you're selling, produce, things like that, they have a low profit margin because it's more or less a homogeneous product. You can't sell your tomatoes for 50% more unless you tell everybody they're organic or something. I meant to be facetious there, folks. And so, but in other industries where you have product differentiation, like a Rolls-Royce sells for more than a Chevy, even though they both have the same number of wheels, you're selling differentiated products. But produce is basically produce. I mean, you could argue about what kind of tomatoes are best or what kind of potatoes are best, Idaho versus Maine or whatever, but there's not going to be much of a price differential for commodities. And so with customers like this, if you're making 1.5%, that may be good. It depends on what industry you're in. But the first thing is to calculate. It's a positive number, 384, that's good news. How good is it? Well, 384 divided by 29,200, between 1% and 2%. So it's not great news. You're probably not going to throw a party over it, but it's nice that it's positive. So product margins computed using the traditional cost system. The same approach as far as margins, dividing the bottom line by the top line, but now we're using a different approach to see what numbers go in there. So the first step in computing product margins is to gather each product's sales and direct cost data. What's the difference between this one and the slide we had a few slides ago? This is the traditional cost system. What's different? How many direct costs do we have here? 2. Yeah, direct material and direct labor. How many direct costs did we have under ABC? 3, because there were 3 costs you could trace. The other one was delivery or something, right? So like shipping, yeah, shipping. And that's a sales cost. So for here, because we're using the traditional approach, we're only using manufacturing costs that we can trace. And there are 2 of those, direct material and direct labor. If we use activity-based costing, we can include all the traceable costs. Some of those may come from selling or administrative. If they're traceable, they can still be direct costs. That's one of the main differences between ABC costing and traditional. ABC costing, you're not limited to just manufacturing costs. You take direct material and direct labor to manufacturing costs, plus any other traceable costs from either selling or administrative. That's the main difference between activity-based costing and the traditional approach. So on this slide, we have the traditional approach. That's why they only have direct material and direct labor, because shipping is a selling expense. So product margins computed using traditional costs. There's someone computing those margins. She's smiling, so it must be good margins. The second step in computing product margins is to compute the plant-wide overhead rate. If you were to criticize that last sentence, how would you criticize it? I just mentioned plant-wide overhead rate. What's the pro and the con of the plant-wide overhead rate?
It's complicated.
Yeah.
It's
Yeah, it's inaccurate. The good news is it's easy to compute because there's only one for the whole plant, either direct labor hours or machine hours or something. So the good news is it's easy to compute. There's only one rate. The bad news is it's not very accurate. What's the alternative to a single plant-wide overhead rate? Begins with M, U-L-T-I, multiple overhead rates. Can you think of two? One of them is direct machine hours. What's the other one? Direct labor. I could say just machine hours, not direct. Yeah, machine hours and direct labor are the two that this book uses. So, okay. This is meant to be a review, but you know the fact that you're not answering my questions indicates that I should review this, I think, because it ties in. So anyway, manufacturing overhead costs. They have production department. All the overhead by definition is an indirect cost. It could be indirect labor, it could be indirect materials, it could be indirect something undeterminable. So indirect factory wages, factory equipment depreciation. I have another question for you, not to be sidetracked, but can you allocate depreciation to products? The answer is yes, sometimes. Does it depend on what depreciation method you use?
That's the question?
Yeah, those are, I'm asking a series of,
Did you answer the first question?
yeah, I sort of answered the first one. Sorry about that. Yeah, I'm just going down the path here. I should only ask one question at a time. Yeah, there are different depreciation methods. You remember from the other accounting class?
Yeah.
Maybe.
You know, when you acquire something and you work the depreciation that you're gonna do every month or yearly, like that.
Mhm.
So of course, every time, let's say if it's yearly or monthly, at the end of the month, you depreciate this much until it's exhausted.
Right.
So now the second question, is you already answered that, so now this next question.
Well, the next question is that there are several kinds of depreciation methods. Some are based on time and some are based on usage. What's an example one based on time? They begin with S. Straight line. That's probably your favorite one, right? Straight line. It's just whatever the thing costs minus salvage value divided by a number of years. Remember that one? Straight line method. That's based on time. That's sort of like a fixed cost, right? You know, if a machine costs $100,000, you can use it for 10 years and then throw it away. There's no salvage. 100,000 divided by 10, 10,000 a year. Regardless of the level of production, you're going to deduct 10,000. So that depreciation would be a fixed cost. Can you think of a depreciation method that would make that into a variable cost?
The usage.
Usage, yeah. Yeah, if you buy a machine for $100,000 and you estimate it's going to produce 100,000 units over its lifetime, then it's going to be worthless and you throw it away. So there's no salvage value. $100,000 cost divided by the 100,000 units you expect to produce. Every unit you produce is $1 in depreciation. That would be a variable cost. How does that affect what we're doing here? Are we sort of treating depreciation like it's a fixed cost? No?
No.
Factory equipment depreciation, $3,500,000. Sort of sounds like it's a fixed cost. They don't tell us, they don't give us any additional information. They don't tell us where that 3.5 million came from. If it's 35 million divided by 10 years, then it's a fixed cost. But what if it's $3 a unit times the number of units? Then it's, I mean,
Because the question, the way I got the question was based on what you just said.
Mhm.
Does it affect that? So if we doing variable, of course it does, because the depreciation changes depending on the unit produced.
mm-hmm.
That's how I understood it.
Yeah, that's exactly correct. Yeah. And so the reason I brought this issue up, I didn't mean to confuse you, but I meant to sort of elaborate. Sometimes there's some stuff between the lines on these slides, and this is one of them. They're treating depreciation here as a fixed cost, apparently, which it can be if it's based on time, like the straight line method, whatever the cost minus salvage value divided by a number of years, regardless of the level of production, that's a fixed cost. So straight line depreciation is fixed cost. Some of those other methods that are based on time are fixed cost. But depreciation doesn't have to be fixed if it's based on units of production or mileage. You know, for a truck or a car or something, 35 cents a mile, $2 a mile, whatever it is, that's a units of production. So there was a hand raised in the third row.
There, it's a fixed cost, how do you know?
It just looks like a fixed cost. For those in cyberspace, how do I know that 3,000,005 is fixed? It looks like fixed. Yeah, they don't tell us where it came from. And they're probably using straight line because the vast majority of companies use straight line as either their only method or their primary method. So based on the assumptions, if you didn't know, it's probably straight line, which means it's fixed.
Isn't it irrelevant though, using the ABC?
Well, yeah, another question, is it relevant whether it's fixed or variable? If it's traceable, it would be traceable if it's variable, wouldn't it? The more hours you use a machine, the more the machine cost is. That would make it a variable cost, and it's traceable to a particular product. So even if the machine makes 14 different products, if it's based on machine hours and you can trace it, and depreciation is so much per machine hour, that would be a traceable cost, which means ABC could give you two different answers depending on whether depreciation is either a fixed or a variable cost. Here they treat it like fixed because it's easier. But you may work for a company where it's based on some kind of a variable calculation, and that would affect your ABC. I don't think the authors pointed that out. Right? When I go through the chapters, I don't read them in depth because they all say the same thing. But I do sort of scan them to see what those subtopics are covered. And I didn't see that one covered. Maybe I missed it. Did they mention depreciation based on machine hours? Or, I mean, they mentioned machine hours, but yeah. In this case, it looks like it might be fixed. And then, so we're allocating it based on machine hours. Sure starts again, 800,000 times 0.6. Where did the 0.6 come from? 36 minutes, right? 36 over 60 is 0.6 hours. And the 0.8 hours, that's 48 minutes. 48 over 60 is 0.8. So that's the total machine hours. So the plant-wide manufacturing overhead rate is whatever the total cost is, 14 million divided by 800,000 machine hours, or 1750. An overall plant-wide rate might be okay if you produce something that's machine intensive or capital intensive. If there aren't many people working there, I think I told you about my father-in-law. Some things I can't tell you, but one thing I can tell you, he used to work in this steel plant in eastern Ohio, around Youngstown, Warren, that area, and he worked the night shift. The night shift, there were only 3 people working, and they controlled all the machines in the factory, and they would make these rolls, and one guy would push a button, and another guy would push a button, and they raise it, and they lower it and stuff. And these 3 guys were using multi-million-dollar machines to produce steel. So when you're allocating this, it doesn't make sense to allocate it on the basis of labor hours, because there's only 3 guys, and they're using millions of dollars of machines. So machine hours would be a better way to allocate overhead in that case, because it's very capital intensive. So they could get by with a plant-wide manufacturing overhead rate that's based on just one cost driver, machine hours, if it's that kind of operation. But if they had one that was assembly and one that was milling and one that was something else, maybe they'd be better doing 2 or 3 different activity bases.
Why would they only 3 people? Because the 9 differentiation? Because it cost more to pay more people, or?
Well, they were getting like a 10 or 20% wage premium because they worked the night shift, but there's only 3 of them, and so that was chump change, so to speak, to the steel company, and they were still able to run the whole operation because I don't know exactly what they did there. My father and I would talk about stuff, assuming I understood what he was talking about, sort of like here, and I'm assuming you know what I talk about. But anyway, for the night shift, they only needed 3 people. For the day shift and the afternoon shift, they needed more than 3, so they must have been doing some other stuff. But the night shift, they only needed 3. And they were making rolls, they were grinding rolls, and they were taking them from point A to point B. I think one of the 3 people might have been a truck driver. You know, somebody hoists the things using a big crane, and they put it on a truck, and then the guy drives it into the parking lot or something. And he has to wait, and it takes 30 to 45 minutes to make one of those rolls. So the truck driver sits around, then he gets in the truck, and he drives at 312 feet or whatever it is, and then he maybe goes back to the factory, maybe takes a nap, maybe he has a beer, I don't know what they do, but he gets paid for that, and that's 3 people running the night shift. So I didn't ask my father-in-law what their cost accounting system was because he didn't know. So he knew his job, and he knew the other 2 jobs in case the guys called in sick or something. That was about it. The third step in computing product margins is allocate manufacturing overhead to each product. So you have sure starts, 480,000 machine hours at $17.50 each, so you just multiply that out. And long lives, that's 320,000 times $17.50. So a total of 14 million. So the overhead allocated equals machine hours times the overhead rate. And there we have some people computing product margins, and their vision is focused on that machine. Reminds me of when I was at the airport in Quebec. Did I tell you that one? They demanded to know the password to my computer in order to let me into the country. I was going there for a tournament, and they demanded to know the password to my computer. I didn't know what my rights were in Canada. I mean, in the United States, I could have told them what to do, but Canada, I don't know. So I gave it to them. And there were 3 people hovered over my computer for about a half hour. Well, I asked them, what are you looking for? And then one of them said, oh, we look for many things. And after I kept badgering them because they started getting a little aggressive, what are you looking for? They said kitty porn. Yeah. I don't know what that has to do with national security. Why did they pick me? Why didn't they pick some young kid? You know? So anyway, they didn't find anything, obviously, because it wasn't there, by the way. It's not that they just omitted it. So anyway, when I see this picture, it's sort of like 2 of the 3 people who were looking at my computer for a half hour. So, yeah. So then I searched the internet after I got back to see what the deal was. And apparently it's a controversial issue, demanding passwords for telephones and laptops. And it hasn't been resolved by the Supreme Court in Canada yet. But it's becoming an issue here, too, because sometimes TSA guys will demand your password here, too, for entering the country. That hasn't happened to me yet. Okay, it's just an aside. That won't be on the CPA exam. Okay, so now we have the 4th step is to actually compute the product margins. So we're losing $2 million on this, but let's try and break it up a little bit. For sure starts, they have the 3 categories, direct material, direct labor, manufacturing overhead, and then a total there. And sales, 31,300,000, and they subtract the overhead items, and they come up with a product margin of 6,900,000 for sure starts. And for long lives, it's 2,000,001. So the total for the 2 products is 9 million, but selling and administrative costs are 11 million. So they're losing $2 million. And again, the shipping expenses are 3 million, marketing expenses are 2, general administrative is 6. So that's where the 11 million comes from. And product margins using the traditional approach. Let's look at sure starts first. The traditional approach to product margins was 6.9 million. For ABC, activity-based costing was 8,372,000. It's like a difference of almost 1.5 million. It's because of the way we calculate. What's the main difference between activity-based costing and the traditional approach? Yeah, the overhead is not assigned, and we have 3 direct costs for ABC versus 2 direct costs for traditional. And for long lives, 2,000,001, a positive number versus a negative number of 1,132,000. The difference between a positive and a negative, you add them together, 3,232,000. It's either positive 2,000,001 or a negative 1,132,000. So there's a difference there of 3.2 million. So you can see a major difference if you use traditional costing versus activity-based. Which one is better? Should I say that? The B word, better? Yeah, it depends. You know, what do you want to do with the information? And how relevant is it to what you're doing and so forth? But it's an additional tool. Activity-based costing is an additional tool. It shows you a little different approach to measuring things like costs and profit margins. The traditional cost system overcosts the sure starts. The sure starts are, let's see, activity-based is 8 million something versus 6,000,009. Overcosts the sure starts and reports the lower product margin for this product. The traditional cost system undercosts the long lives and reports a higher product margin for this product. So there are 3 reasons why the reported product margins for the 2 costing systems differ from one another. Traditional costing allocates all manufacturing overhead to products. ABC costing only assigns manufacturing overhead costs consumed by products to those products. And traditional costing allocates all manufacturing overhead costs using a volume-related allocation base. ABC costing also uses non-volume-related allocation bases. And the third one, traditional costing disregards selling and administrative expenses because they're assumed to be period expenses. ABC costing directly traces shipping costs to products and includes non-manufacturing overhead costs caused by products in the activity cost pools that are assigned to products. So basically, you have 2 chargeable or traceable costs, direct material and direct labor under traditional costing, and under ABC costing you have that third one, the freight costs or shipping. And the difference again between product cost and period cost. Targeting process improvement. Activity-based management is used in conjunction with activity-based costing to identify areas that would benefit from process improvements by focusing on activities to eliminate waste, decrease processing time, and reduce defects. So here's another use of this. If you can sort of cut out some unnecessary costs or eliminate some of them, but you don't know until you look at the numbers. Activity-based costing activity rates can also provide valuable clues concerning where there is waste and the opportunity for improvement. And benchmarking, you've run into that term before, right? Yes, yeah, benchmarking, you look at the numbers of your best competitor and try to match or beat your competitor. Benchmarking, this is the goal to shoot for. Benchmarking can be used to compare activity cost information with standards of performance achieved by other organizations. So you can look at the competitor that's down the street or in the next town, or you can look at the competitor who's best in the industry, compare your numbers to that competitor, and to see how you're doing. And activity-based costing and external reporting. Again, activity-based costing is internal reporting. External reporting would be like on your annual report, your quarterly statements, your SEC filings, things like that. Again, the numbers are going to be different because for external reporting, we have to use GAAP, Generally Accepted Accounting Principles, or IFRS, International Financial Reporting Standards. If you're outside the United States, most countries use IFRS. So external reports are less detailed than internal reports. They give summaries. Like, well, for instance, you know, if you've ever looked at an annual report, should I ask how many have an annual report? They're easy to get. If you want General Motors, you go to Google, type in General Motors annual report, and out it comes. They have a consolidated income statement where they take all the income statements from all their subsidiaries, they put them together on 1 or 2 pages. It destroys a lot of information because it's a summary. You want it to fit on 1 or 2 pages. They have a consolidated balance sheet, 1 or 2 pages, all the assets, all the liabilities, all the owner's equity accounts, 1 or 2 pages. Destroys information, but it enables you to see the overall picture in 1 or 2 pages. So when they say external reports are less detailed than internal reports, sure. Because internal reports, you can show product margins for all of your 853 products. You wouldn't dare do that on an annual report because you don't want your competitors to see that. It may be difficult to make changes to the company's accounting system. And certainly if for external reporting, you can't just change the system. There are certain accounting principles you can use, but you have to be consistent. You just can't change from one acceptable principle to another one every year. What would be an example of that, where you change from one acceptable accounting principle to another acceptable accounting principle? Give me one example.
Maybe if you merge with the company and that's what they use.
Oh, yeah, I hadn't thought of that one, but yes.
If you expand outside the US.
Yeah, that's another one. If the company has a merger, maybe one company's on FIFO, first in, first out accounting for inventory. The other one is on, well, FIFO is first in, first out, LIFO, last in, first out. You may want to change one of those methods so that they're consistent. I might also mention for international financial reporting standards, depending on the country, because there's sort of country specific too. A lot of times you have to be on the same inventory method for all your subsidiaries. I mean, subject to some exceptions. So let's say a company that's on LIFO, last in, first out, merges with a company that's on FIFO, first in, first out. Somebody's going to have to change their accounting method under international standards in some countries, because sometimes there national rules that conflict with that, but basically that's it. In the United States, they don't do that. If a company uses LIFO and it merges with a company that uses FIFO, they report both of them. They might have an inventory figure listed on the balance sheet. Then in the footnotes, they might say 60% FIFO, 30% LIFO, 10% other methods or something like that. That's one difference between the US GAAP and international. Again, it may be difficult to make changes in the accounting system for a variety of reasons. That's one. Activity-based costing does not conform to GAAP, generally accepted accounting principles. But it doesn't have to, because it's like applied microeconomics. It's for internal reporting only. GAAP, generally accepted accounting principles, only applies to external reporting, like financial statements. And really, if you're not a publicly traded company, you don't have to use GAAP. Yeah, but if you don't use GAAP and you go to the bank for a loan, they're going to say, I want an audited statement using GAAP, and if you don't have one, you don't get the money. So there's market forces there that say you should use GAAP even if you're not publicly traded. Authors may be, or auditors may be suspect of the subjective allocation process based on interviews with employees. When the external auditor comes in to audit the company, they ask questions to employees. One of the questions they might ask is, how do you allocate overhead? Does anyone remember Cliff Robertson? No. He's a movie star. He made westerns, cowboy films, some mystery things. He did a couple of World War II movies. Well, the way they account for overhead costs in Hollywood, the way they used to do it, is for the top actors where they're negotiating, the actors would get a percentage of the bottom line. But what they did, if they made 10 or 20 movies that year, they would allocate their overhead in such a way so that the bottom line of some of their biggest hits would be close to zero. There's even a joke that if they let Hollywood accountants do the books for Star Wars would have lost money. I don't know if that's true, but it's sort of a joke within the profession. But now that you know something about allocating costs, I mean, think about it. You have all these costs. You have different ways to allocate them. Why not allocate them in such a way that you can screw the actors out of their percentage? Save money, millions of dollars. So that's what they did in Hollywood until Cliff Robertson came along, and he sort of called them on that. And now he was sort of blackballed for that and some other stuff that went on because they didn't want the secret to come out. But now, and a lot of actors didn't even know that they were misallocating costs. But now the smart actors with good accountants and good attorneys, they'll try and take their percentage off the top based on a percentage of sales. And they don't care how the costs are allocated because it doesn't affect them. They get their 1 or 2 or 3% or whatever it is off the top instead of the bottom, because the bottom may be zero by the time they get allocating costs. by the time they get done allocating costs. So that's a real life example. How do they uncover that? Well, the auditors would interview employees. That's one way they could do that. Or if the actor has a good accountant or attorney, they might say, where did this number come from? And how did you allocate the cost? There are some limitations to activity-based costing. Substantial resources required to implement and maintain. You have to pay people to do this. You have to keep extra records that you wouldn't have to keep otherwise. You have to create more numbers, more records. Resistance to unfamiliar numbers and reports. If you took this into the boss who was a management or marketing major, they may not understand this. Maybe they don't want to hear what you have to say. You run into those people probably, right? If you've ever worked for more than 5 years, you probably ran into at least one of those people. You just don't want to hear it. And some reports never get read. This one place I used to work for, we actually eliminated some reports because we run around in the office and they asked, do you ever read this report? Do you ever read that report? And if everybody says no, we quit making those reports. A lot of companies don't do that. They just make them automatically, regardless of if anybody reads them or not. If nobody reads the reports, you're wasting your time. So you might want to do that. The next time you don't want to read a report, go around the office and ask if anybody ever uses the information in that report to make a decision. If the answer is always no, you quit making that report. So again, resistance to unfamiliar numbers and reports. They may not do anything with those numbers because they don't know how to use them. It could be a tool, but they don't know how to use the tool. Desire to fully allocate all cost of products. You don't want to do that because of those, the president's salary and so forth. You don't want to allocate that. Potential misinterpretation of unfamiliar numbers. If they don't understand where the numbers are coming from or what to do with them, they may misinterpret them. Just like that one example we had 10 or 20 slides ago, where the bottom line was less than zero, and I asked, should we discontinue that product? They may say yes, because they don't understand there's more involved than just having a negative bottom line for one product. So potential misinterpretation of unfamiliar numbers. And activity-based costing does not conform to GAAP. So if you use activity-based costing, you have two sets of books. Well, you'd have three because the tax rules are different. Even legitimate companies have two sets of books, one for financial reporting and one for the tax people, because the tax rules are different. It's possible you could actually make a loss for tax purposes and a profit for financial reporting purposes. Can you think of the most common reason why that might be true? You make a profit on the books, but you lose money for tax purposes? Happens a lot in the real estate industry. Go ahead. I'll pretend you raised your hand. Were you going to say depreciation?
Yeah.
Okay, thank you. Yeah. For financial reporting purposes, the vast majority of companies, over 90% in the United States, use the straight line method, either as the only method or as their primary method. For tax purposes, there's another method you can use, MACRS, M-A-C-R-S, Modified Accelerated Cost Recovery System. That's an accelerated method where you take larger chunks of depreciation in the early years, smaller chunks in the later years. So if your assets are relatively new in the first half of their life, you're going to take larger depreciation deductions on the tax return than you do on the annual report, the financial statements. Because of that, you could actually drive the bottom line to be less than zero for tax purposes, even though it's more than zero on your annual report. And then there's a way to show where those differences came from. There's a whole other set of things about that, but that's in the financial accounting class, which you've apparently survived because that's why you're here, right? Or at least most of you have taken that. Okay, so that's it for the slides. So I'm going to stop sharing for a minute, and then I'm going to let's see, this one, I guess. Now we go to the number crunching. So let's take a look at page 255. Now, this is chapter 6 in a book that has 12 chapters. So after tonight, we'll be 50% through with the course. How about that?
Oh, yeah.
Yeah, yeah. Now you should feel sad. You say, oh, no, I want more. No, maybe not. Okay, let's take a look at exercise 1, page 255, activity-based cost hierarchy. This is just terminology. There's no numbers to crunch here. The following activities occur at Greenwich Corporation, company that manufactures a variety of products. Rather than run through A through H, again, this is a good time-saving device. If you feel under pressure to answer questions because of time constraints, you ever feel that pressure? Yes? Okay.
All the
Yeah.
time.
Okay, yeah. Here's one way to make effective use of your time. When you look at something that looks at A through H and you don't know what you're looking for, skip that. Go to the requirement. I mean, eventually you're going to have to come back. It says, the requirement, what are we going to do with this information? Classify each of the activities above as either a unit level, batch level, product level, or organization sustaining activity. Again, those organization sustaining activities would be like the president's salary, the rent on the corporate headquarters 1,000 miles away, stuff like that. So let's see what we have. You receive raw materials from suppliers. You make stuff in batches, perhaps, so that would be batch level. Manage parts inventory, that would be for particular products, so that would be product level. You do rough milling work on products, so that would be a unit level, because products are in terms of units. Each unit is milled. What is milling anyway?
Where's what?
Milling. Do rough milling, M-I-L-L-I-N-G, for part C. Exercise 1, part C. It says do rough milling work on products. What do they usually mean by milling? I mean, it could be for grain and wheat, but that's not what we're talking about here. That's a different kind of mill, right? Well, in the steel industry, when you have these rolls of steel, and they don't come out perfect. They have sharp little edges sometimes. There are machines you can use to grind down the sharp edges so nobody gets cut. That would be one example of milling. Or let's say that you have something that's supposed to be 3/4 of an inch and it's a little bit over because there are little chunks here and there. What you can do is grind that down till it's 3/4 of an inch. That would be called milling. So that's what that means. Again, not on the CPA exam. Well, milling might be, but you don't have to know what it means. Part D, interview and process new employees in the personnel department. Well, that would be an organization sustaining kind of thing. It's a corporate headquarters or something that you don't want to allocate. Part E, I might also mention organization sustaining activities. Those are the costs that you don't want to allocate. That's another name for it. Part E, design new products. That would be product level. Part F, perform periodic preventive maintenance on general use equipment. That would be an organization sustaining thing. You don't want to allocate that. And G, use the general factory building. That's one of my favorite examples of organization sustaining. You don't want to allocate that. Part H, issue purchase orders for a job. That would be a batch processing system. That's it for that one. Now we get to the first stage allocations for, let's see. Okay. You may not be able to see that last column because there's other stuff there. I could, maybe I can get rid of this one. There we go. So number 2, first stage allocation. Secura Corp operates a fleet of armored cars that make scheduled pickups and deliveries in the Los Angeles area. The company is implementing an activity-based costing system that has 4 activity cost pools: travel, pickup and delivery, customer service, and other. The activity measures are miles for the travel cost pool, number of pickups and deliveries for the pickup and delivery cost pool, and number of customers for the customer service cost pool. The other cost pool has no activity measures because it is an organization sustaining activity, so we don't allocate that. The following costs will be assigned using the activity-based costing system. So you have the driver and guard wages, vehicle operating expense, vehicle depreciation, customer representative salaries and expenses, office expenses, administrative, and then they have a total. And on page 256, the distribution of resource consumption across the activity pools is as follows. So they have it in percentages. I'm not going to go through all of them, but let's take a look at the first one. Driver and guard wages, 50% is allocated to travel, 35% to pickup and delivery, 10% to customer service, and 5% for other. So the requirement, complete the first stage allocation of costs to activity cost pools as illustrated in Exhibit 6-6. Sounds like the marketing majors are out of control in the next room, out in the hallway or something. Okay, for those in cyberspace, we had a minor disruption, probably caused by marketing majors, of which 80% of the cyberspace students are probably marketing majors. Okay, so what do? We're going to multiply the dollars by the percentages, right? In the case of, well, let's see, the driver and guard wages, the total is $720,000. So where does the $360,000 come from? Under the travel there, the $360,000? Yeah, it's 50% of $720,000, right? Total cost $720,000. Travel, 50% of that, based on the top of page 256, 50%. 50% of $720,000 is $260,000. Where's the $252,000 come from? 35% of $720,000. So you just take the totals, whatever's in the total column, and you multiply it by whatever percent the book tells you to. So 35% of $720,000 is $252,000. 50% of $720,000 is $360,000. You're not gonna make me go through all these, right?
Well, the service is 10%, you know that.
Yeah. Yeah, service, you can do that in your head. 720,000 times 10%, 72,000. Chop off a zero. So, and it's the same procedure for all of those. So let's not go through all of those. But so each entry in the table is derived by multiplying blah, blah, blah. Okay, so we did that. And I don't want to spend too much time on unnecessary stuff, so we can spend more time on the good stuff. I mean, it's all good stuff, folks. Don't get me wrong. It's all good stuff. Yeah. Some is just a little more thrilling than others. So here we get the various percentages. You know, travel 50% of 720, 35% of 720, 10% of 720, and so forth. So that's where we get all those numbers. Are there any questions about number 2, by the way, before we go on? If I go on and you have questions, just stop me. Try to answer. Number 3, compute activity rates. Green Thumb Gardening is a small gardening service that uses activity-based costing to estimate costs for pricing and other purposes. The proprietor of the company believes that costs are driven primarily by the size of customer lawns, the size of customer garden beds, and distance to travel to customers, and the number of customers. In addition, the cost of maintaining garden beds depends on whether the beds are low-maintenance beds, mainly ordinary trees and shrubs, or high-maintenance beds, mainly flowers and exotic plants. Accordingly, the company uses the 5 activity cost pools listed below. So caring for lawn is based on the number of square feet. Caring for garden beds that are low maintenance is the square feet for those low maintenance beds. Caring for garden beds high maintenance, again, square feet of high maintenance beds. Travel to jobs based on miles. Customer billing and service based on the number of customers. The company has already completed its first stage allocations of cost and has summarized its annual cost and activity as follows. So caring for lawns, the estimated overhead cost there is $72,000, and you divide that by 150,000 square feet to come up with 48 cents. Looking now at the chart for the screen, 48 cents, 0.48. Where does that come from? 72,000 divided by 150,000, 0.48. So the cost of caring for lawns, 48 cents per square foot. So when somebody comes to you and says, I have 5,000 square feet, I want you to cut it, how much should you charge? Well, 48 cents would be your cost. If you want to make a profit, you would charge more than that. But 48 cents is the least that you could charge without losing money, unless there's some other factors to consider and so forth. And you do that with all these other things too. Caring for garden beds, that was given 26,004. Again, the nice thing about these textbook problems, they give you the numbers. You don't have to figure out where did that 26,004 come from. And then low maintenance, you have to define what's low maintenance, what's high maintenance. So, and it's either one or the other. It's not a combination. There's not a third because this is a textbook. So you divide that by 20, and you get $1.32 per square foot. And then, another thing comes to mind too. You may have several people working for you. Maybe one person can only do lawns. You pay that person $10 an hour maybe. The people who do this high maintenance stuff, they have to have more job skills. So you don't want to cut a bonsai tree in the wrong direction or something, right? If you have really fancy lawns that require a lot of care and expensive plants and stuff, you have to pay them more, so their job rate per hour would be more. It's another thing to take into consideration, which we don't do here, but it's a textbook example, just to show you the basics. Care for garden beds, high maintenance, 41,400 divided by 15,000 square feet, so that'd be $2.76. Travel to jobs, 26 cents a mile. Now here's an interesting thing. Should we inject ethics into this class, or is that a forbidden topic? Yeah, go with it, right? Yeah, here it takes them 26 cents per mile to travel to the jobs. Let's say the IRS allows you to take a 55-cent deduction for that. Should you take 55 cents?
Yeah.
Yes. Yeah, sure. Why not? It's the law, right? It's not even an ethical question there, apparently, in this audience. Okay. Okay. If it's legal, therefore it's ethical, I guess, right? Is that? You didn't do that here. I'm just. Some people disagree. Okay. Customer billing and service, 8750 divided by 25 customers, 350 per customer. So okay, so that's it for that. Is that all there is, or is there more? These are pretty easy, actually. It's just they give you a bunch of numbers. You just have to figure out what to do with them. You know? Yeah. Which numbers match up? What do I do? Multiply, divide.
It's easy because you're not tired.
Right.
It's easier to see different depth and it's also easier because it's laying it out in tiles rather than paragraphs. So when this information is handed to you in a paragraph,
Yeah.
and that's 5 minutes to do it.
Yeah. I don't give you the schedule with column headings. But you do have 6 minutes on average. So.
I thought I read somewhere you say we're gonna increase it by 10 more minutes.
No, it's 12.
Did y'all get that?
Yeah. Oh, yeah.
Yeah.
Oh, that's like around here.
There we go. I was going to increase it by 10 minutes when it was 50. So I increased it to 60. Yeah. And there's something to be said for having time testing, you know. If you really, really know your stuff, you don't even have to refer to the book. You just burn through them and you finish 60 questions or 10 questions in 16 minutes or something.
Yeah, but this is the thing though,
Could
I don't know, I can only speak for myself. I have a phobia when I know I'm being tried.
The pressure.
I don't care how much I know here, it's like,
The pressure.
you know.
Yeah.
Yeah. I'm trying to make it a real life situation, you know, where you work under pressure. No, I'm not trying to. I'm just. If you have 30 minutes of question, you can call KPMG and say, no, you don't do that? I just gave you a new idea. You don't have anyone to call.
Yeah, we can call, question 5.
Yeah, some of you have done that actually.
Yeah, but time is ticking.
Yeah, it's the thing. I mean, you know, if you have unlimited amounts of time, you have all kinds of resources. But I want to see if you sort of know the stuff. I don't mind if you look at the book, because, I mean, that's okay. But you only have 6 minutes per question. You know, if you had 20 minutes a question, you could look at the book for the first time. I want you to actually read the chapter first, do some exercises and problems first so that you have a pretty good feel for what's going on before you even take the first quiz. If you do that, you'll probably.
You read the book, right?
You're not getting what I'm saying.
I will attempt these.
Mhm.
But then when you say it and connect, it's like a paragraph, so it's not like laid out,
Yeah,
like you see it here. So
Yeah.
it's somewhat confusing.
yeah.
I'd say, when you say like, I mean, I feel like I'm pretty familiar with a lot of material, but
Mhm.
it takes 3 minutes just to structure it in this format, like,
Right.
extrapolating the data,
Yeah.
putting it how you need to for your brain
And then calculation.
to do it, and then you
Yeah.
calculate, and then you double check your work.
Yeah.
And then when you guys like,
Yeah.
parts, and you gotta go back and then go build part, no, oh my goodness.
Everything is on.
And then you go use the measure what you see here, and then you gotta go back
Mhm.
and decipher which part you got wrong.
And then you're convinced they gave you the wrong multiple choice.
Yeah.
And some of them you be like, okay, you get the answer like so easy, you're like, no. They can't do that.
Yeah. Yeah. For the benefit of those in cyberspace, we're having a discussion about exams. If you think you got the right answer and it looks so easy, maybe it's not the right answer. Or sometimes it is. You never know. But if you read through the chapter, again, the best way to use your limited time, don't read the chapter 10 times. I think I mentioned that, right? Read it once, maybe twice tops, and then go through the exercise and problems. And if you can't solve it, find those particular paragraphs that are on point. Spend your time reading those 1 or 2 or 3 paragraphs. That'll help you get the answer when you're not being time tested for those exercises and problems. That's how the best way to make, or the best use of your time is to do it that way. Don't read the chapter more than once, maybe twice tops, because your time could be better spent crunching the numbers, solving as many exercises and problems as you can, and do it more than once. If you find that you're only getting the stuff right half the time, do those exercises and problems a second time. Keep doing them until you always get them right, if you have enough time.
Yeah.
Yeah, the exercise and problems at the end of the chapters. Yeah, just keep doing them over and over until you get an 80 or 90 or 100% success rate. That's when you know when to stop. Of course, I'm assuming I'm the only course you're taking. You have no job, family responsibilities. It's just me and my course, right? I know that may be unrealistic in 1 or 2 cases, but I mean that's the way to make most effective use of your time. Let's take a look at number 4. Number 4, second stage allocation. Klumper Corporation is a diversified manufacturer of industrial goods. The company's activity-based costing system contains the following 6 activity cost pools and activity rates. So for supporting direct labor, it's $6 per direct labor hour, machine processing $4, and so forth. You have machine setups, production orders, shipments, and product sustaining. Activity data has been supplied for the following 2 products, K425 and M67. So they give you the number of units produced. And right away, you see number of units produced, you want to multiply it by something, right? Yeah, probably something from that top table on 257. Then direct labor hours, machine setups, production orders, shipments, product sustaining. So all you have to do is multiply one number times another. It's just a question of what 2 numbers do you put together. So the requirement, determine the total overhead cost that would be sustained to each of the products listed above in the activity-based costing system. So this is mostly about structure. You just set it up and then multiply. In the case of supporting direct labor, for instance, it's $6 per direct labor hour, and the activity is 80 direct labor hours. So you multiply 6 times 80, you get 480. Multiply 4 times 100, you get 400. And you just keep doing that until you run out of numbers. It's a total of 1,874. That's for K425. Then you do the same thing for the other product, M67. $6 times 500 is 3,000 and so forth. And the total, 10,540. And unless they ask you to do something else, that's it. You're done. Is that all there is to this? I think it is. Yeah. Most of the time is just structuring these things, putting them in the columns, figuring out what to do, multiply or divide one number by another. Number 5, product and customer profitability analysis. Oh, this is going to be a good one. Profitability analysis. How profitable are these customers? Thermal Rising Inc. makes paragliders for sale through specialty sporting goods stores. The company has a standard paraglider model, but also makes custom designed paragliders. Management has designed an activity-based costing system with the following activity cost pools and activity rates. So they have supporting direct labor, $26 per direct labor hour. And then they have order processing, custom design processing, and customer service. Management would like an analysis of the profitability of a particular customer. Big Sky Outfitters, which has ordered the following products over the past 12 months. So you have 2 columns there. You have the standard model and you have the custom design. Number of gliders, 20 of one, 3 of the other. Number of orders, number of customer designs, and so forth. So basically, what do you do with that information? You figure out which numbers go with which other numbers. It also says the company's direct labor rate is $19.50 per hour. So the requirement is using the company's activity-based costing system, compute the customer margin of Big Sky Outfitters. So we can start with sales. In order to figure profitability, it's basically sales minus all the costs. So let's start with sales. $1,850 per standard model. And they sold 20 of those, so you multiply that by 20. And then the other model, the custom model, $2,400 per custom model. They sold 3 of those, so you multiply that by 3. So the total sales, $44,200. Yes?
Can you do it like the individual way and then add it together? Like,
Yeah, you could do that. Yeah, you could have 2 columns, one for each product. You could do it that way too. The authors don't do it that way, but you could. Yeah. Sometimes there's more than one way to solve these things. You could have 2 columns, one for each product. And then for direct materials, again, 564 times 20 plus 634 times 3. And the same with direct labor and supporting direct labor, all those various things. There's so much good stuff here, we can't get it all on the same screen. So let's scroll up a bit. So the customer margin, in other words, it's a profitable company because it's a positive bottom line, $1,144. So the question is, how profitable is that company?
Yeah, by the top.
Yeah, divide the bottom line by the top line. Divide 1,144, and the top line is 44,200. Yeah, I can get it all on the screen here, I guess. So 1,144 divided by 44,200. I did this in my office this afternoon because I had nothing better to do. Comes out to be 2.6%. Is that good or bad? Oh, if the industry average is 1%, that's fantastic. If the industry average is 10%, not so good. So they made 2.6%. 1144 divided by 44,200 is 2.6%. That's their profit margin. What if most of their other products are 30%? Then this is not such a good product compared to the other ones. What if the average in the industry is 20%? 2.6 isn't so good. So basically what I'm trying to show you is you compute the number, and then you have to compare it to something else. Yeah, it always depends. Yeah. The industry average, maybe other products, maybe you make 20 or 30 other products, and all the others are at least 10%. This one is only 2.6. What if you don't have enough hours in the day to make everything you want to make? What do you cut out? You might cut this one out, right? Yeah. If you only have 24 hours in the day, you only have a certain number of employees and so forth. If you have more business than you can handle, you take the most profitable stuff and forget about the rest. You may discontinue this product line,
That's what I was gonna say.
even if it's profitable.
I said, that's why some product did discontinue.
Uh-huh.
Because maybe at some point it used to be like the hottest, product. And then now it's not so hot, and then eventually they're gonna discontinue. But you said it.
Did you see, I don't know if this is a scam, but Reese's,
Mhm.
whoever manufactured Reese's said they did the marginal cost for whatever, and it's no longer profitable.
Oh,
They might-
they're not doing Reese's anymore?
They said they wanted to hold out to Halloween. I don't know if it was a prank on Facebook, but
Ah,
yeah.
Man, it'll be there.
Yeah.
They did Twinkies.
yeah. Well, Reese's has so many things. I went into one of these truck stops when I was going between point A and point B one time, and they had like 5 or 10 or more different kinds of Reese's.
Yeah.
Yeah.
But see, also, I think that has to do with increase in allergies. I mean, there's a lot of children who are like allergic to peanut butter.
Yeah.
Like even like for Halloween, like you say, I refrain from nuts, like candy with nuts or peanut butter, because you never know.
Yeah. Don't give nuts and peanut butter to kids at Halloween because they might sue you if they're allergic. I mean, that never used to happen.
Yeah.
Or don't
Yeah,
put
he said that.
don't put razor blades in apples because they might sue you. You know, there's all kinds of, yeah. So anyway, there's something else I was going to mention, but I forget what it was now. Oh, well, what was it? Oh, yeah, in Dunkin' Donuts. Do you use Dunkin' Donuts products from time to time? They make more than donuts, right? It used to be you could go in there and get a croissant filled with tuna fish. I went in there a couple months ago. They don't have tuna fish anymore. If you want a croissant filled with something, it has to be filled with either ham and cheese or chicken or something. They got rid of the tuna fish. Why would they do that? Yeah, probably somebody did an analysis like this, and they figured we'd be better off filling it with chicken or ham and cheese or something. Not enough people like tuna, maybe. I don't know.
If you do it tuna, it's cost effective. It costs enough. If you make tuna, fish products have to have their own section, period. You
Uh-huh.
cannot make no other products on it except for that particular seafood product. And they probably will have to solve it. If they continue to do that, then transfer factor for that tuna, gonna get on that ham or that other meat product, and somebody will turn around and sue them. Because they know the only way they could get that seafood contamination
Uh-huh.
is from the fact that they did not use clean material in making that same.
Ah,
So that's why some products and some restaurants don't do seafood anymore because they have to have their own station.
ah,
So that's
okay,
why
good point.
I've gotten away from it because of the same fact.
Yeah.
And also, you know, the sitting out.
Mhm.
Have you ever saw how if you leave it out for a period of time? Yeah.
Yeah.
So
Yeah.
it's just too.
Yeah, those in cyberspace aren't benefiting from this conversation. Unless, they used to have microphones hanging from the ceilings, but, yeah. So, yeah, basically, another reason they might not sell seafood products is because they have to have a separate processing station, because seafood might have salmonella or something, and you can't, you have to have separate machines and all that. And if you put all of that into the allocation, they figure maybe the cost of having a separate station exceeds the benefit.
Yeah.
So, yeah. And in some of these other stores, like in like Jewish neighborhoods or Muslim neighborhoods, they don't like ham for some reason. And so if you sell ham, they might not buy it even if you use separate equipment. But I mean, think about it. If you use the same thing to slice chicken and slice ham, you're going to lose a lot of business. So you have to have 2 different slices, one for chicken, one for ham. And some of them won't even go there anyway, but some of them will. So you won't lose as much business if you have 2 meat slicers, one for chicken and one for ham. So,
Design cost.
yeah, design cost. Yeah, you can't just wash those off after everything, because some people think washing isn't enough. I used to live in this one, Teaneck, New Jersey. They have like 11 synagogues within walking distance. That's how Jewish it is. And some of them are Orthodox. And when I knew this person in real estate, and she loved to sell to Jewish couples because if they bought a house that wasn't owned by a Jew before, the woman would insist that they tear out the whole kitchen and put in a new one. And she had a relative who worked in that business. And so she would, yeah. So she would sell it to this couple knowing that they would tear out the kitchen, and then she would give them her brother or brother-in-law's card. He would make a new kitchen for them. And so there's a whole little market for that. That's like a design setup cost kind of thing.
There's
So,
a show called Property Brothers like that. I don't know if you know about that. You got one in the real estate and his brother's construction. So he sells you a house, and his brother fixes the house.
Oh,
Property Brothers.
yeah.
I used to watch
Which you explained.
Property Brothers, yeah, the TV show. I haven't seen that one.
I didn't come in with that part.
My wife likes to watch those fixer-upper things,
Yeah, like that.
where they buy a house and they fix it up. Yeah, yeah. She watches that every night. Man,
Your wife does?
yeah,
I did too.
yeah.
Ended though.
Yeah, so. Yeah, well, there's it's entertainment value, plus you learn stuff, you know.
But you know, it can cost you too, because you give your wife ideas. Next
That's the
thing
thing.
you know, she had no-
Yeah, the wife gets ideas. She say, "We can do that, and it only costs $3,000. Why don't we do that?"
No, and then you're like, $3,000, let me do the books. Nope, it only costs $1,500.
Yeah,
I should
That costs you-
yeah, yeah.
No, honey.
Let's use inferior materials and then sell it. No, that's ooh. Okay, so where are we going with this? Okay, so basically the profit margin 2.6% could be good, could be bad. The fact that it's positive is at least sort of good news. But okay. All right. See, number 6. Cost hierarchy. Oh, there's a lot of stuff to read through there. A through I. Should we just read through that?
We could do that.
Yeah, you can. Yeah, well, you can do all these at home, really, but let's do a few for the purposes of whatever, repetition. Let's look at the requirement for number 6. Classify each of the activities above as either a unit level, batch level, product level, customer level, or organization sustaining activity. In order to duplicate a particular CD is a product level activity. Assume the order is large enough that it must be broken down into batches. So we have CD Express Inc. provides CD duplicating services to software companies. The customer provides a master CD from which CD Express makes copies. An order from a customer can be for a single copy or for thousands of copies. Most jobs are broken down into batches to allow smaller jobs with higher priorities to have access to the machines. A number of activities carried out at CD Express are listed below. So the first one, A, sales representatives' periodic visits to customers to keep them informed about the services provided by CD Express. That would be like a customer-related cost. Ordering labels from the printer for a particular CD, that would be a product cost. Setting up the CD duplicating machine to make copies from a particular master CD would be a batch level cost. Loading the automatic labeling machine with labels for a particular CD would be a batch. And visually inspecting CDs and placing them by hand into protective plastic cases prior to shipping, that would be a unit thing.
Can I ask you a question?
No, it's nothing after 7:30. No questions after 7:30. Oh, go ahead. Yeah, it's before
I'm just trying to
7:30.
make, so like, Steve, the reason why it's unit is because you taking it individually, and one by one, and then versus B and C, you could see like a whole bunch and they print, that's what it says batch.
Yeah,
Literally, okay.
yeah, yeah. For those in cyberspace, the reason E is unit is because you're looking at things individually, whereas well as it B and C, you're looking at a clump there. Well, B would be for a product. B, ordering labels from a printer for a particular CD, that would be for a particular product. And C is a batch because you're making copies from a particular thing.
Quick question, why is it that X is not batch?
Okay, question, why is F not a batch? Let's take a look at F.
Because it's already made out, it's about to get, it's a finished product and it's about to be shipped.
Yeah, preparation of shipping document, yeah,
Ship in a batch.
yeah, it's already a product. Yeah.
Because it's a product.
Yeah, some of these, they could maybe have more than one answer that looks pretty good. Yeah, well,
No.
yeah, you're
Okay, what-
supposed to pick the best
Batch
answer.
of stuff. Can you put it as batch or not?
Well, if it's a batch, like, again, my favorite example of a batch is a bakery. You know, they put a bunch of ingredients together and they make a batch of bread or a batch of donuts or something. That would be like the easiest case. They do several at a time, kind of thing. Was somebody talking here, or was that one of my cyber students? Okay, because I hear voices and I don't know where they're coming from. Because
Oh, a psychiatrist.
yeah, I mean, theoretically, the people in cyberspace have microphones; they can ask questions too,
Everything is,
unless they're muted.
everything is free, your voice sounds.
Yeah. Okay, so where did we leave off? G, periodic maintenance of equipment. That's an organization sustaining thing. That's not something you would allocate, because again, the managers would get mad if you did that. Part H, lighting and heating the company's production facilities. Again, that's like the corporate headquarters, the president's salary. That's organization sustaining. You don't want to allocate that. Part I, preparation of quarterly financial reports. That even has nothing to do with production. You certainly don't want to allocate that. There's nothing to be gained by doing that. So that's it for 6. Shall we go on to 7? Yeah? Okay. Number 7.
What, chapter 7 you said?
No, number 7. Number 7. I know you're anxious to get to chapter 7, but let's hold off on that one until next week. Oh, look at this. We have arrows. You know it's got to be good if we have arrows, right? The whole thing only takes 10 minutes. Might take you 10 minutes just to write this out. Yeah. Yeah, on average. So, exercise 7. This is a good example of how you can actually apply this. We had, most of these questions are about manufacturing, but we also have service industries. And this one is about banking. This is a service industry. You can use the same principles and apply them to the service industry, not just manufacturing. Number 7 is about first stage allocations. The operations vice president of Security Home Bank has been interested in investigating the efficiency of the bank's operations. She has been particularly concerned about the cost of handling routine transactions at the bank and would like to compare these costs at the bank's various branches. If the branches with the most efficient operations can be identified, their methods can be studied and then replicated elsewhere. So let's say you're in a branch banking state, you have 30 branches in the state. Some branches do things more efficiently than others. How do you know which ones are more efficient? Well, you can do something like this to figure out, how much does it cost per minute to do this, or how many transactions can you process in an hour? And then if there's a range, if some do 2 or 3 times as well as others, you go to the one that's most efficient and you ask the question, how did you do that? And then once you find the answer to that, you go around to the other branches and you say, this is how they did it. And you can cut your cost by 43.1% if you do what they do. So this has a practical application.
So it's like internal benchmarking, using the best practices.
Yeah, internal benchmarking. Only instead of comparing your competitors, you compare other branches of the same organization. And the nice thing about doing it that way, you know what the numbers are because it's your organization. If it's a competitor, you have to guess. While the bank maintains meticulous records of wages and other costs, there's been no attempt thus far to show how those costs are related to the various services provided by the bank. The operations vice president has asked your help in conducting an activity-based costing study of bank operations. In particular, she would like to know the cost of operating or opening an account, the cost of processing deposits and withdrawals, and the cost of processing other customer transactions. The Westfield branch of Security Home Bank has submitted the following cost data for last year. So they have teller wages, assistant branch manager salary, branch manager salary, total of about $315,000. Virtually all other costs of the branch, rent, depreciation, utilities, and so on, are organization-sustaining costs and cannot be meaningfully assigned to individual customer transactions, such as depositing checks. So the rent for the branch wouldn't be allocated to the check cashing function. In addition to the cost data above, the employees of the Westfield branch have been interviewed concerning how their time was distributed last year across the activities included in the activity-based costing study. Results of the interviews appear below. So they have for opening accounts, processing deposits and withdrawals, processing other customer transactions and other activities. They have things like teller wages, assistant branch manager salary, the 3 categories. So the requirement at the top of page 259, prepare the first stage allocation for the activity-based costing study using Exhibit 6-6 as an example. So you can structure it like this. You can have a separate column for each item, opening accounts, processing, and so forth. And then teller wages, assistant branch manager, like they do there, with the percentages that are given. So I have a question for you. For the teller wages there, under opening accounts, teller wages, 8,000. See that 8,000 in the opening accounts teller wages? Where did that come from?
5%.
5% of 160,000, right? Yeah, 160,000 times 5% is 8,000. And 160,000 times 65%, what do you think that would be? 104,000. Yeah, 160,000 times 65%, 104,000. So you get all of these by doing the same thing. You multiply whatever the total is times the appropriate percentage, and you come up with these numbers. So opening accounts, it cost them a total of $23,250 to open accounts. Is that the end of the story, or is there something we can do with that number? If they told us how many accounts they opened, you can take the dollars and divide it by the quantity, right? 23,250 divided by the number of accounts opened to get the cost per account. Of course, you could save money by not opening accounts, right? Don't do that, folks. Don't save money by not opening accounts, because after all, yeah, you're not going to have a bank if you don't open accounts. So once upon a time, so many stories I can tell you about Bank of America. Does anyone work for Bank of America here?
I met with them.
Yeah, so somebody in cyberspace probably does. Well, here's the deal. I tried to, what was that? I think I wanted to open a checking account or something. But I moved to a new city. I wanted to open a checking account. I called. Is it okay if I come in to open a checking account? They said, well, we'd like to make an appointment. We have an opening in like 2 weeks or 10 days or something. Do you think I'm going to wait 2 weeks to open a bank account with any bank? I don't have any loyalty to a bank. I just went to another bank. They were trying to operate efficiently, fill in the schedule, 10 days, 2 weeks. So I didn't open my account at Bank of America in that city. Another time, another city, I was in a Bank of America office talking about something, sitting down at the desk with somebody. The phone rings, and it kept ringing. 10, 15, 20 rings. I said, aren't you going to answer the phone? She said, oh, no, we're shorthanded today. We decided we're not going to answer the phone today.
Oh my God.
Yeah, that's Bank of America. Okay. So for all you, if I have any students who work for the Bank of America, be sure to tell your boss's boss's boss what I just said.
And get fired, huh?
Well, maybe. You might get fired. Watch, what you say. Write the note anonymously. But anyway, that's not a good example of customer service. So, one way to eliminate $23,250 is not to open up accounts. But don't do that. Because if you don't open accounts, eventually you're not going to have customers, because you have a certain number of customers who move to another city and they close their account or something. So, don't do that. So, but there are ways you can maybe cut that cost from 23,000 down to maybe 18 or 15. If you have enough branches, somebody's going to have a better number on a per account basis. You have to take that 23,250 and divide it by something, the number of accounts you opened. So how much does it cost you to open one account? And then you can figure out what the cost per account is. Are there any questions about any of the numbers on this screen? No? Okay. So it tells you here based on the errors where the numbers come from. But basically you multiply something by something else. Number 8 is a continuation of number 7. This exercise, number 8, is a continuation of number 7. It should be assigned only if exercise 7 is also assigned The manager of the Westfield branch of Security Home Bank has provided the following data concerning the transactions of the branch during the past year. So they have opened accounts. They opened 500 accounts. So we take that, what was it, 23,250 divided by 500 to get $46.50. That's what it takes. Or that's the cost, rather, of opening a new account, $46.50. Processing deposits and withdrawals. They had 100,000 deposits and withdrawals processed, and processing other customer transactions, 5,000 of those. The lowest costs reported by other branches for these activities are displayed below. So here we get to the benchmarking thing. You calculate what your costs are, and then you compare it to the other branches. So for opening accounts, $46.50 is what it costs your branch. For processing deposits and withdrawals, $1.08. Processing other customer transactions, $12.50. So the first requirement, well, we already did the first requirement. Using the first stage allocation and above that, compute the activity rates. We did that. Part 2, what do these results suggest you concerning the operations? Well, you compare it to the other ones. Opening accounts at the lowest cost branch cost $26.75. It costs you $46.50. The lowest branch did it for $26.75. So what do? You go to that low-cost branch and say, how did you do this? And then when you find out, what do? You go to the other branches and say, this is how that branch did it. Let's see if you can do the same thing. And then processing deposits and withdrawals, the lowest other branch is $1.24. You're doing it for $1.08. Other branches are going to come to you and say, how did you do that? And then processing other customer transactions, $11.86. Yours was $12.50. So you go to the branch that did it for $11.86 and you see how they did it, and you can perhaps upgrade your processing system so that you can have a better profit margin with lower costs. Are there any criticisms that can be made of what we just did here?
Yeah, I was just thinking about it, because like, I used to live in a small town in Nevada called Mesquite. It's about an hour northeast of Vegas. And there's only about 14,000 people there. So their Wells Fargo branch is not going to do anything like what their Vegas branch is going to do. It's just an hour away. You only have 15,000 people. So like, for example, if you wanted to decrease that $46.50 per account, then you need to open more accounts. And if you only have a certain demographic, you can't reach beyond what you can reach, you know? So in some cases, you just have to accept that that's going to be higher because of demographic factors you can't control.
Yeah, some things you can't control, like how many people walk through the doors. Yeah, competition, yeah. Cost of living, yeah. Tellers in New York City get paid more than people in Iowa, I'm assuming.
I was also going to ask you, like, and what is an acceptable time period to get these averages? So is this like after a year that you're looking at all these fixed numbers and then dividing it by this and dividing it by that and then getting this? So like, so the executive branch, the manager say, oh, it costs us $46.50 to open an account. How long does he use that? Till the next year, till the next quarter? Like, I mean, how quickly does that data become obsolete? Yeah. For those in cyberspace, what time period should we take into account here? We should probably calculate these on an annual basis, because you might have a seasonal business. You know, if it's in Florida, a lot of people go there for the winter months, and so you have more activity. Then all those people from Brooklyn and Queens and Yonkers and stuff go to Florida. And in Canada, I used to live in Miami Beach. We had a lot of Canadian license plates, French speakers and stuff. So yeah, it could be seasonal. So if you do it over a 12-month period, you get the average. And then you don't have to necessarily recalculate this every year. It depends on how much it fluctuates. But every 2 or 3 years, maybe come up with some different numbers. It may not be difficult to get these. If you can do these in 10 or 20 minutes, just assign it to somebody to do during their lunch break, right? If you want to be cruel and make them work during lunch. I mean, these figures are not difficult to come up with, but you have to dig for the information. So if you don't think it fluctuates much, just do it every couple of years to see what the new numbers are. But again, part of this cost is driven based on how many people walk through the door. If they're not walking through the door, you're paying a teller to work 40 hours a week and only 10 people walk through the door, that cost is going to be higher because you take the salary divided by 10. If 40 people walk through the door, you take the salary and divide by 40. One thing you can do to get the unit cost down is to have fewer tellers. What's wrong with that?
The line service is 14
Yeah, you don't want to stand in line for a long time, right? Yeah, one time I went into Walmart, the one on Ramsey, or there may be more than one on Ramsey, but one of the ones on Ramsey, and I had like a basket of stuff. There were like 10, 12 people ahead of me in line, and they were really slow, and I was in a hurry. It's very annoying. One person actually left her cart right there, and she had like, I don't know if she had ice cream in there or something, meltable stuff. I don't know what she had, but yeah. So I don't know if that's Walmart's intention, probably, because they're a pretty smart operation the way they work. You know, they work on small margins. They're known for working on small margins, but they have tremendous volume. But if you lose customers like that because the lines are too long and they walk away and they have things like ice cream in their basket, you know, you're going to have some extra product losses there that you wouldn't have if you hired an extra teller.
Like she said, it depends on where to,
Mm-hmm.
because some people, let's say, if it's a rich neighborhood, they don't have time to waste. I mean, they want to be
Yeah.
special, they want to feel here.
New Yorkers,
So, hey,
they really like their time, those New Yorkers. They don't want to wait around.
yeah, but you know.
Somebody in the
again,
Midwest, they
New
had
York's-
nothing to do. They sit on the porch and listen to the grass grow. That's a different kind of customer.
But then New York too, we're used to for services, people just being nasty. And, you know, like in Jamaica, Queens, or, you know, those areas.
Uh-huh.
You
Yeah.
stand there and people don't even look at you, $10 and take this and that check. Bye, next.
Yeah.
So I'm just saying.
Yeah. Remember, one time I was in the New York subway. You know how they had these turnstiles that you walk through? Some guy was standing there, obviously a tourist from the Midwest or something, standing there holding his little 4-month-old baby. And this guy pushes him out of the way to go through the turnstile. And he said, hey, what are you doing? I mean, the guy is obviously from the Midwest. The New Yorker pushed him right out of the way. Could have dropped the kid. He pushed him so hard. That's just a different,
Yeah.
they have different value on time. Now, I don't know where the guy was going. He could have been going to the next subway station or something. But yeah.
His wife had been like,
Yeah, he could have been running from the cops. They do that in the New York subways a lot too. But I don't know why he was in a hurry, but he pushed this guy out of the way with the 4-month-old kid. So, yeah, the same way with standing in line at Walmart. You could get away with that in the Midwest maybe, but you try that in New York, people are going to just walk away and let the ice cream melt. But that's one way you can get these costs down is by having fewer tellers. But then there's trade-offs in life, right? Like in microeconomics, there are trade-offs. You know, you could lose business if the lines are too long. You could get these costs down, but then you'll lose customers maybe. So it's something else to keep in mind. We don't talk about that in accounting because that's extra stuff. You know, the basic thing is all other things being equal, right? That's the economist's escape clause, but all other things are not equal sometimes. You could cut some of these costs, but then you might lose business by doing that. So you have to figure, how did that other company get it down to $1.08 or the $23, whatever it was, instead of 46? Just figure if the cost of making the change exceeds the benefit. And again, there are a variety of reasons why these exercises and problems don't go into all that. Time constraints for one. But when there's something obvious that has to be discussed, I think I should bring it up. Number 9. Another second stage allocation. Durban Metal Products Limited of the Republic of South Africa makes specialty metal parts used in applications ranging from the cutting edges of bulldozer blades to replacement parts for Land Rovers. The company uses an activity-based costing system for internal decision-making purposes. The company has 4 activity cost pools as listed below. So they have order size, customer orders, product testing, and selling. And they're based on the number of direct labor hours or customer orders, whatever, and they have a cost there. $16.85 per direct labor hour, for instance. The managing director of the company would like information concerning the cost of a recently completed order for heavy-duty trailer axles. The order required 200 direct labor hours, 4 hours of product testing, and 2 sales calls. Well, you know what you're going to do with this, right? You're going to take those numbers and you're going to multiply them by something. It's just a question of what. So the requirement, prepare a report summarizing the overhead cost assigned to the order for heavy-duty trailer axles What is the total overhead cost assigned to the order? So we just have to figure out what numbers to multiply by what other numbers. The activity rate, again, the order size, $16.85 for direct labor hour times 200 direct labor hours, $3,370. And the customer orders 320 times 1. Product testing 89 times 4, and selling 1090 times 2. So 6,226. Again, easy conceptually. It's just you have to figure out what number to multiply by what number, and then you have to add them. That's it. Questions about that one? No? Number 10. This is another good one. It's the real life situation kind of thing here. Customer profitability analysis. Worley Company buys surgical supplies from a variety of manufacturers and then resells and delivers these supplies to hundreds of hospitals. Did you run into anything that looked funny when you read this one? Something immediately popped out at me. Did it pop out at you too?
$1?
Well, yeah, they set their prices for hospitals by marking up its cost, blah, 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 by 5%. They have a 5% markup. What kind of markup is that? Yeah, it's a wonder they make any money if they only mark it up by 5%, 30, 50, 200%. Now you're talking, 5%. What do you do with that?
Well, they're trying to be modest.
Yeah, I guess. Yeah, I mean, this is an example. It illustrates the point. I wouldn't use 5%. I'd squeeze more than that out of them if I could, but 5%. For example, if a hospital buys supplies from Worley that it costs Worley $100 to buy from manufacturers, Worley would charge the hospital $105. It makes for an easy example, but I don't know how realistic it is. For years, Worley believed that the 5% markup covered its selling and administrative expenses and provided a reasonable profit. However, in the face of declining profits, Worley decided to implement an activity-based costing system to help improve its understanding of customer profitability. The company broke its selling and administrative expenses into 5 categories. So for customer deliveries, the number of deliveries, total cost $500,000, deliveries $5,000. So what are we going to do with that? Divide, right? 500,000 divided by 5,000. And manual order processing, number of manual orders, 248,000 divided by 4,000. Electronic order processing, number of electronic orders, 200,000 divided by 12,005. Line item picking, number of items picked, 450,000 divided by 450,000. You can do that one in your head. And then other organizations sustaining costs, 602. We don't divide that by anything because that's organization sustaining, right? Yeah. Which means we don't allocate it. Worley gathered the data below for 2 of the many hospitals that it serves, University and Memorial. Both hospitals purchased a total quantity of medical supplies that it cost Worley $30,000 to buy from manufacturers. So the cost for manufacturers is the same. If they add 5% to that, they get whatever they get. But the cost structure is different here because the number of deliveries, University was 10 versus Memorial 25. Each time they make a delivery, it costs money. So Memorial, it's going to cost them more to deliver because they do it 25 times instead of 10. Number of manual orders, 0 versus 30. Every time you have to process a manual order, somebody has to push the pencil or push the buttons on the computer. Number of electronic orders, 15 versus 0. No electronic orders, there's no cost associated with processing those because there aren't any. In the case of 0. Number of line items picked, 120 versus 250, more than twice as much. So you can see here, even though they charge each company $30,000, the cost of delivering is going to be different for those 2 different companies. So the requirement, compute the total revenues that Worley would receive from University and Memorial, compute the activity rate, and so forth. Well, the cost is going, or the revenue is going to be the same. You have a 5% margin. You could multiply that by 1.05. This is a 2-step process, right? 30,000 times 5% is 15, then you add the 15, 100 to 30, you get 31.5. You could just multiply 30,000 times 1.05. It's a 1-step process. You still get 31,500. And then for the activity rates, Again, it's 100 per delivery, 62 per manual order, and so forth. Once you get those, the 100, the 62, the 16, and the 1, you just multiply them by the number of whatever the thing is that you're multiplying by. Number of orders or deliveries, whatever. Electronic orders, manual orders. And so this is what you get. For university, your total activity costs are $1,360. For memorial, a lot more, $4,610. 13, this is like 3.5 times what that is, right? Memorials costs are about 3.5 times what universities' costs are. You're only making $1,500, right? You're making $1,500, $30,000, and you sell it for $31,500. Revenue is $1,500. Here you're making a little bit because 1360 is less than $1,500, 5% of 30,000. But here it's a lot more. So you're losing money on memorial. What do? Do you drop memorial as a customer, or you do? No, you just tell them we'll deliver once a month. No, you might not do that. You lose them. No. Life-saving stuff you deliver once a month. Not everyone will die. The people that need it on delivery day will live. Customer margins. Again, here you're losing money. 31.5 minus 30,000 cost only leaves you 1,500 in gross profit, and then it costs you 4,610. So you're losing 3,110 for memorial. You're actually making $140 on university. It's pretty much break even. Well, 140 divided by 31,500 is almost zero, right? You're not making much there, but you're not losing. So for part 5, what does it ask for part 5? Describe the purchasing behaviors that are likely to characterize Worley's least profitable customers. Well, hospitals that require frequent deliveries. Every time you make a delivery, it costs money. So you can cut down the number of deliveries. That would be one way to cut your costs. Place a high volume of manual orders. Tell them to place it electronically. The whole world is going toward that, right? When you order a book from Amazon, you do the work. If you go to a Travelocity or something, you're the one who books your own ticket. They save a lot of money doing that. And orders may, order in many line items likely to be profitable. So again, those are some things you can do to cut the cost so that you can actually make money. Or you can charge 30% instead of 5%. Or you can do both, cut cost and increase the margin. Okay, judging from the rustling in the rows here, it appears it's time for a break. People are packing up. For those in cyberspace, people are packing up and starting to leave. It's their way of telling me politely that it's time for a break. Except the person over there who left 45 minutes ago. But who's counting, right? Okay, we covered a lot of material. I mean, we almost never cover everything because there's just too much good stuff. But we covered a lot. And you do have the answers to these and some other ones I didn't have a chance to cover, so that's good. Again, if you have any questions, feel free to send me an email. I may not answer it at 3 in the morning. It just depends on what I'm doing. Usually I'm sleeping at 3. Yeah, don't call. Yeah, don't arrange to call me every 15 minutes. Okay, well, thank you. Those who stayed, thank you for staying.
Thank you.
Yep.
Well, thank you.
Yeah, thank you. See you next week if you have nothing better to do. Right? Opportunity cost. Let me just, okay, let me just turn this off there.